Honorable Speaker of the Parliament, dear colleagues, ladies and gentlemen, my name is Remo Holsmer and I'm the Vice Chairman of the Finance Committee of Estonian Parliament. It is my privilege and pleasure to welcome you all in Tallinn and to open the Interparliamentary Conference on Stability, Economic Coordination and Governance in the European Union. We have approximately 180 participants in our conference. I hope that everybody had a safe and convenient journey to Tallinn, and I'm glad to see you all here. This building is a former Tallinn Central Power Station, which began operating in 1913 and was closed in 1979. Today, called Tallinn Creative Hub, is a multifunctional cultural center and serves as the main venue for the Estonian presidency events. Dear colleagues, as you know from the program, we are going to have intense 2 days. The 4 sessions will focus on the future of the economic and monetary union, on stability and growth measures like national reforms, financial assistance and investment programs, and we will also discuss tax collection efficiency and challenges for EU budget in light of the change in EU is facing. And now, I'm delighted to give the floor to the President of Riigikogu, Mr. Eiki Nestor, who would like to welcome you here on behalf of our Parliament. Mr. Nestor has been elected to the Riigikogu at all the 7 consecutive elections held in Estonia since regaining our independence. Mr. President, the floor is yours.
Thank you. Ladies and gentlemen, dear colleagues, a warm welcome to you all on behalf of the Parliament of Estonia, and I am pleased to greet you here in this former power plant. Today it's a digital powerhouse, a creative hub where the ideas for the future Europe are generated and debated. Dear colleagues, I have participated, as you heard, in the Estonian politics for 25 years. And for the most of that time, I have the honor of being a member of the Finance Committee of our Parliament. In every Parliament, this committee is the committee that keeps the feet firmly on the ground and does not build castles in the air. The members of that committee must know how to calculate. Therefore, I believe that you all are the people who understand one simple truth. If the nations of Europe want to be successful in today's world, then there is no alternative to greater cooperation. We will not be able to succeed by ourselves alone. Together, this is possible. Europe can be the leader and the pioneer here. Greater cooperation is our advantage and not the drawback, no matter how much the skeptics speak about it. You can gain votes at the elections by proclaiming lies, like promising to give the people back the work, by the way, that has been taken over by robots or by the internet. On real life, this will not happen. So let us keep our cooperation and let us do more together. There is no point for the countries to count their small victories here. In a longer perspective, these are useless victories. Our common interest is a successful European. Member states together can achieve more than they could by acting alone. Therefore, the exchange of information and the best practices concerning financial matters is essential. This meeting provides a perfect platform for a debate and exchange of ideas. I wish you fruitful discussions and much success in the important work that you do. And enjoy your stay. Thank you.
Thank you, Mr. President. Before we proceed to the first session, I would like to inform you on some practical matters. Firstly, the conference is live streamed on our webpage. We will share the mood of the conference via social media in Facebook and the Riigikogu Twitter account and the Riigikogu Flickr account. You are most welcome to share your ideas on the topics of this meeting on Twitter by using the hashtag #ParlEU 2017EE. There's an information sheet on your desks where you can find all the relevant information about the interpretation services, how to access the Wi-Fi, and how to register for the debate. For requesting the floor, we have an electronic system and the manual is on your desk. I will come back to it later. We also have a working area for the delegates. To find it, please follow the signs or ask our staff. Now, let's move on to the first session, and we have approximately 1.5 hours for it. In this session, we will discuss the future of the economic and monetary union. The European Commission has launched a broad debate on the future of the EU 27 and issued the reflection paper on deepening the economic and monetary union. The options presented in the paper would involve taking steps in 3 key areas: completing a genuine financial union, achieving a more integrated economic and fiscal union, and anchoring democratic accountability and strengthening euro area institutions. Also, the fiscal compact foresees a discussion on its substance within the legal framework of the EU. I'm keen to hear your thoughts and expectations on EMU's future design and how to get there. Also, how to reinforce democratic accountability and what would be the role of national parliaments in these. In this session, we have 2 keynote speakers. Our first keynote speaker is Mr. Valdis Dombrovskis from the European Commission. Our second keynote speaker is Mr. Roberto Gualtieri from the European Parliament, and looks like that he's in a plane right now, but hopefully he will land on time, so we will hope to see him a little bit later. And after the keynote speeches, I will give the word to the session's co-chair, Mr. Jürgen Ligi from Estonian Parliament. Both keynote speakers will have 15 minutes to make their speeches, and then we will have about 50-55 minutes for the debate. Colleagues, registration for the comments and speeches is open from this moment onwards. You can request the floor electronically from the seat reserved for you. To register your request, please press the head button on your conference unit. First one, I see. Thank you. Please follow the instructions on your desk. You can take the floor after the presentations, and we will address you when it's your turn. Now, I would like to warmly welcome our first speaker, Mr. Valdis Dombrovskis, the Vice President of the European Commission for the Euro and Social Dialogue, also in charge of financial stability, financial services, and capital markets union. In addition, he is a former Prime Minister of Latvia, former Minister of Finance, and former member of the European Parliament, to mention just a few of his merits. Mr. Dombrovskis, the floor is yours.
Mr. Chair, honorable members of European Parliament, honorable members of national parliaments, first of all, thank you much, Estonian presidency, for organizing this debate. The European Parliament and national parliaments have a key role in working towards a more efficient, transparent, and democratic economic and monetary union. Having this debate here at Estonia adds a symbolic point. Like a country I know best, Latvia, Estonia has opted for the euro after the financial crisis, following the fundamental logic of monetary integration, even or especially in difficult circumstances. The single currency gives us an additional sense of stability in a global economy and provides us with opportunities for growth, giving a small but open economies the chance to make full use of the freedoms of EU single market. At the same time, Estonian case shows how each member state needs to make the best possible use of these opportunities for itself. Economic and social convergence cannot be guaranteed from outside. Even in the Eurozone framework, much of the responsibility and many tools remain primarily at national level. In case of Estonia, we see that results are there. Estonian economy is well on track. GDP growth is revised up to 4.3% this year, according to government estimates, and European Commission will issue its forecast next month, and we expect this also to point at a strong economic performance. Both employment rate and labor force participation are at their highest in 20 years. So congratulations on this solid economic performance. Yet today's discussion highlights the fact that even with growth steadily broadening across the euro area, we remain aware of the need to improve the performance of our economy. With flows exposed during the crisis and convergence stalling ever since, the debate on how to make economic and monetary union perform better is ongoing. The Commission, as you know, is taking the initiative in these discussions. Certain options were outlined in our reflection paper in May. President Juncker elaborated on some of the ideas in his State of the Union speech last month, and will come out with specific proposals on 6th of December. There are some key principles that should drive the discussion on completing the economic and monetary union. First of all, completing the EMU is not the end in itself, but a way to provide jobs, growth, social fairness, economic convergence, and financial stability. Responsibility and solidarity, risk reduction, and risk sharing have to go hand in hand. The economic and monetary union should remain open to all EU member states, and the decision-making process must become more transparent and democratically accountable. With those principles in mind, it's clear that the discussion on EMU reform is one in which all EU member states should actively participate. Ladies and gentlemen, to be sure, since the crisis, many of the weaknesses had been addressed. For instance, with stronger oversight of fiscal and economic policies, with more watchful eye on banks, focus on prevention and correction of harmful imbalances, and more attention to cross-border aspects of policies and risks. In the short term, completing the banking union and the capital markets union are the most immediate priorities for future reform. Both are needed for our economies to improve access to the financing they need for future growth. They are also vital for us to be able to absorb shocks and share risks through private channels to ensure that taxpayers are not first in line to pay for financial sector mistakes. We must step up our efforts to implement the decisions that have been already taken, such as agreement on the backstop of Single Resolution Fund and the strategy of non-performing loans. And we should strive to agree quickly on the remaining proposals, such as risk reduction package of last November and the European Deposit Insurance Scheme. This is where our recent communication on completing the banking union comes in. It's a contribution to support co-legislators in finalizing key pending banking union files before the end of this legislature. The communication suggests a possible remodulation of European Deposit Insurance Scheme proposal, introducing it more gradually, having 2 phases instead of originally foreseen 3 phases, concentrating on liquidity support to national guarantee schemes in the first reinsurance phase of EDIS, whereas maintaining the ambition that in a second co-insurance phase, EDIS would also cover losses, and eventually we would move to 100% European system, and making the move towards second stage conditional of the asset quality review. To be clear, we are not presenting a new legislative text. Our proposal of November 2015 remains on the table, so here we are just providing some additional food for consideration and possibly helping to unlock the deadlock in this discussion. We are also following with interest the ongoing European Systemic Risk Board work on sovereign bond-backed securities. If the technical work is successful, the development of such securities could facilitate the diversification of bank sovereign portfolios, thus further weakening the bank sovereign loop and boosting private sector risk sharing. Being market-driven, sovereign bond-backed securities would not require mutualization or a change in the regulatory treatment of sovereign bonds. For longer-term perspectives, despite progress made, we have not yet been able to sufficiently reverse social and economic divergences across the EU. Those centrifugal forces come at heavy economic and political price, and if they remain unaddressed, it's likely to weaken citizens' support for the EMU. In this State of the Union speech, President Juncker announced a number of initiatives with both short-term and long-term perspective. The announced creation of a dedicated euro area budget line within the EU budget should provide for a number of functions directly relevant for convergence. Structural reform assistance. We know structural reform works, but we also know that it's slow, painstaking, and sometimes costly effort. Since this year, we have in place structural reform support program to provide technical assistance to member states for the implementation and evaluation of reforms. We can build on this further, and we see that interest from member states to use this instrument is very large indeed. Euro area fiscal stabilization function, for which we presented 3 options in May EMU reflection paper. One of the options is European investment protection schemes. In times of strain, public investment is a first item to be cut from national budgets, and this can harm future growth. Such a scheme could take the form of a financial instrument, but we are currently exploring exactly different designs, how we could put a European investment protection scheme forward. And we also look at other options which could include a European unemployment reinsurance scheme and a rainy day fund. It was also announced a convergence instrument to give pre-accession assistance to member states that intend to adopt the euro. This would help those countries to prepare for joining the euro, as well as for them to prosper in euro area once they have done so. Last but not least, we must talk about future governance of economic and monetary union. At present, economic governance is based on the mix of EU and intergovernmental arrangements, which makes the institutional landscape difficult. The Commission is proposing to bring intergovernmental agreements created during the crisis under the community framework. This would allow us to achieve more efficiency and democratic accountability within the Union. For the Treaty of Stability, Coordination and Governance in the EMU, which includes Fiscal Compact, this has already been foreseen since its inception. In the same spirit, the Commission is also proposing the turning of European Stability Mechanism into a European Monetary Fund anchored in the Union framework. This would help us to tackle any future crisis in a Eurozone in a more efficient manner while ensuring greater democratic oversight. With a view of 2025, the proposals also include the setting up of European Minister for Economy and Finance, who would be in charge of overseeing structural reform efforts and coordinating economic and fiscal policy in the euro area. And also with a view of 2025, exploratory work on European safe assets should be continued. Our EMU package of the 6th of December will hammer out these and other proposals in more detail. With the European economy noting consistent and broad-based growth, This is not a moment to sit back and relax. Rather, we need to use this time to strengthen the resilience of our economies and work further to the adjustment capacity of every EU economy and the EMU as a whole. A well-functioning and well-integrated EMU can be much more than sum of its parts. Thank you very much.
Thank you, Mr. Dombrovskis. We have to make some changes. I can assure that Mr. Gualtieri has landed to Tallinn, as far as I know, but I will now give a floor to Mr. Jürgen Ligi, who is former Minister of Finance and has been elected to the Riigikogu 6 times. Now he's a Member of Parliament and also a chairman of the State Budget Control Select Committee. So maybe you can add some comments, and hopefully then Mr. Gualtieri will join us, and then we can move on to the interventions. So please.
Thank you. Let me intervene briefly, not as Mr. Gualtieri, but as former finance ministers during the years of the hardest crisis and elaborating our financial and economic policy rules and also implementing them until 2014. My opinion first is that while talking about deepening monetary union, we should first look at where we are, how deep we are with present agreements and rules. Are we implementing them, or do we need new ones? And this is a critical issue. First, because Europe has appeared to be fragile and even decomposing. Eurosceptic populism is rising, and at the same time, those policies are very much an issue of solidarity. And what I saw in Brussels on our previous meeting, I would suspect that there is a strong sentiment in national parliaments that solidarity should be one way. There were very strong demands about changing the rules and also towards creditors, and even blaming them and of course blaming the rules as if the source of crisis. They were, of course, our rules were outcome of the crisis, the lessons of the crisis. This is unfortunately demoralizing. That is, my experience was that it was very hard to explain in our parliament why should we credit countries with lower discipline, lower level of structural reforms, but higher social standards. Why should Estonia pay? Why should we need FSM and SM? And of course, the same question was in other parliaments whose standards social standards are higher, but still solidarity was something hard to explain at home under those circumstances. And one outcome, of course, of it is that our own national rules have been loosened because there is no explanation why to be so strict and prudent anymore. And our own fiscal policy happens to be pro-cyclical now and in deficit. The average in Europe is more than 1% of structural deficit. I can't understand it why we agreed the rules when we are not following them. And it's more talks about flexibility in the parliaments and also in the Commission's papers than meeting the rules and showing solidarity to each other. One problem of the sentiment is also as if public spending is our deficit, as if Europe's economic problems are in too little spending. Instead, I would say we are world champions in it, in public spending, but not anymore in competitiveness and in private investments. And this is where we should be more attractive and where we should first increase the quality of public spending, not the quantity. So my conclusion is that, which I hope someone at least will touch later, is that deepening of monetary union should first of all be implementing the present rules and not deepening the flexibility. Thank you.
Thank you. Dear colleagues, we are now moving on with your interventions, and first one will be from European Parliament, Ms. Pervenche Perez, please.
Merci, Monsieur le Président. Chers collègues, c'est un honneur de participer à ce débat, mais je nous propose d'avoir un débat utile dans le moment où nous sommes, et donc de sortir de nos caricatures qui...
It seems to me that this debate here is very useful. We need to go beyond these normal ways of talking about these matters when we talk about applying the rules. We must ask ourselves, what are we going to do in regard to these proposals that are in front of us? What are we going to do before the end of the year? What are we going to do in relation to the fiscal compact? We have certain experiences in this regard. The fiscal compact cannot be integrated into the treaties. This would be counterproductive, but we do need to take into account Article 13. What should be our first concern regarding the reform and the future of the EMU is what will happen vis-à-vis the European Stability Mechanism. Some people want to make it into, or turn it into an EMF. We need to know what to do. Some people have come up with a proposal regarding this, and people have said that IMF has been in unhealthy competition with the European Union, but now they want to bring this competition into the European Union on the basis of Article 4. People want to create the European Monetary Fund. This would be a body that would be followed by all rating agencies very carefully. After that, we will have a commission from whom we don't need to take away competencies from. After that, IMF Article 4 will be followed, and the Commission will implement structural reforms, and by doing that we will change the reality of what the structural funds actually are. Structural funds will be turned into macroeconomic conditionality.
Keep your individual remarks within 2 minutes.
Yeah, thank you. I just conclude. Thank you for allowing me to conclude. Et le deuxième volet en dehors de la zone euro étant réservé.
So outside of the eurozone, what will happen there? The fund offered by Mr. Juncker this will turn into loans. The Minister of Finance of the European Union, I don't think this will solve any of our problems in the EU. It is very important to include the European Parliament and national parliaments in this program because this is important. Thank you.
Italy, Mr. Paolo Corrieri Paleotti, please. And I will remind you, please, in 2 minutes, comments or questions to the keynote speakers as well. Thank you.
Thank you. Thank you very much, Mr. Chairman. I think we all agree that the EMU is still an unfinished process, and so we have to complete it. but different opinion exists how and where to intervene in order to complete it. I think that two key areas are indeed crucial today. First, I think we have to strengthen the resilience of the euro area. If unfortunately a new financial shock should intervene, the euro area is not well equipped to deal with this kind of shock. So what is very important for the resilience is to complete the banking union, as has been mentioned by Mr. Dombrovskis before. But here, a classical division exists between countries that want first to reduce risk and countries that say that it's very important to share risk in order to reduce them. So we need a compromise, and the compromise is in order to complete both the second pillar and the third pillar for the banking union. Second, we have to strengthen the growth capacity of the euro area. Monetary policy is the only engine today of the recovery. This is nice and positive, but it's not enough. Structural national reforms are indeed important, but they are not enough to sustain a kind of growth path. I want to, first of all, to highlight the fact that we need a more strong fiscal policy at European level. We need what is called a European fiscal stance, and we are very far from that today. And secondly, we have to strengthen the investment capacity at a European level. The kind of Juncker plan is positive, but indeed is not enough. So this is a second very important kind of area where to intervene. So these two areas is crucial if we want to deepening the EMU in order to sustain the future challenge. Thanks very much.
Sorry for that, but Mr. Gualtieri has arrived. Mr. Gualtieri has been a member of European Parliament since 2009. Among many other topics, he has been closely involved with amending the EU legal framework with regard to stability mechanism for the euro area, as well as with the establishment of the Fiscal Compact, and with the topic of the genuine economic and monetary union. Currently, Mr. Gualtieri is one of the three Brexit Sherpa negotiators for the European Parliament, as well as a member of the Brexit steering group. So I will now break the interventions and give a floor to the second keynote speech. Mr. Gualtieri, the floor is yours.
Ladies and gentlemen, thank you very much. Apologies for the delay. The plane made a 1 hour nearly delay, but I'm very glad to be here and to address you this very important topic. I'm sure Valdis Dombrovskis has already presented the important package that the Commission is going to present in December. And so I would like to make some considerations first on the context where we are having such a crucial debate of a deepening of EMU, and also from some lessons that an analysis of this concept might give to us in order to do well what we are expected to in the next months. First, we should note that this discussion is taking place against the backdrop of a robust and broad-based economic expansion, which is supported by rising private consumption, employment and investment, and record low public deficits. At the same time, we can observe the persistent legacy of the crisis in terms of long-lasting imbalances and still too high unemployment and public debt. Furthermore, we see a more structural problem of insufficient growth of potential output and productivity, too low investments and wages, persistent social inequalities. This economic context offers us a solid base for our discussion of deepening the EMU and provides us with important indications and lessons. The first lesson is that quality of policies matter, not just governance. Our governance framework is clearly suboptimal. We have seen this during the financial and sovereign debt crisis, and neither the establishment of ESM nor the revision of the Stability and Growth Pact and the Fiscal Compact have fully addressed those weaknesses. That's the reason we are discussing about deepening EMU. However, if the crisis is over and recovery is gaining momentum, this is also thanks to the way in which our imperfect and incomplete governance framework has been intelligently managed at various levels in the last few years, especially during this Commission. The ECB has done very well with the OMT that has put an end to the sovereign crisis, while Deauville had triggered it, I would say, and ESM had proven not to have enough firepower, and with the QE, which has been decisive in easing financing conditions, facilitating the leveraging process and supporting domestic demand. But also in the remit of fiscal and economic policy, the member states and the union institutions, in particular the European Commission, have done well, implementing reforms and introducing the necessary flexibility to our fiscal framework, which has allowed to have both a growth-friendly fiscal consolidation, avoiding a new downturn, and reduction, record low of deficit, as I said. In substance, the first lesson we can take from the positive side of the current economic condition and outlook is that the so-called market discipline is not sufficient and can be even counterproductive, as Deauville showed, that union institutions, especially of federal nature, are more effective than intergovernmental ones, and that flexibility is an indispensable feature of a rule-based fiscal framework. If you say PSI at Deauville, you then have more crises and have to pay more, while if you say whatever it takes by a federal institution plus conditionality, you pay less and achieve more. Equally, if you apply intelligent flexibility, you can have both growth and deficit reduction, while with strict austerity, you end up with none of the two. The second lesson coming from the current economic conditions is that while good policies are fundamental, we still have insufficient instruments to fully address our cyclical and structural problems. In particular, the need to strengthen inclusive growth and productivity, boost job creation, promote convergence, support investments, enhance resilience to shocks. In this respect, the fact that we are in better shape, economically and also politically, provide us with a window of opportunities that we should not waste. What are the functions we need in order to address those historic and secular challenges? I would identify 5 of them: crisis management, macroeconomic stabilization, economic policy convergence, fiscal surveillance and coordination, provision of European common goods, financial integration. I will discuss in particular some of them on the basis of what we expect from the coming Commission proposal. First, crisis management. As we all know, the Commission has announced that it will present a proposal for the transformation of the ESM into European Monetary Fund. While in itself this can hardly be defined as one of our most urgent priorities, some focused improvements of the current crisis management function can be useful, especially by making it more autonomous from the IMF. At the same time, an enhanced ESM-EMF, even I don't like the word European Monetary Fund, but this is not so important, should fully respect the Commission competencies in the framework of economic policy coordination and multilateral surveillance procedures. This includes also the macroeconomic and surveillance analysis that currently the IMF performs through its Article 4 consultations. The building up of such a capacity within the ESM-EMF should be avoided, as well as the setting up of mechanisms that envisage automatic debt restructuring as a precondition for ESM-EMF support, which would seriously affect financial stability and hence contradict the very mandate of the ESM. But the most important condition for enhancement of the ESM, which makes also of it an opportunity, is its incorporation into the EU legal framework through Article 352 of TFU. First, they would mean involving in the procedure both the European Parliament and the national parliaments. Second, this would allow the necessary degree of democratic scrutiny of the new body at European level. Third, it would be the condition for a stronger, more streamlined involvement of the ESM-EMF in the program work by making possible what otherwise with an intergovernmental solution would not be possible, an amendment of the two-pack legislation. Finally, an ESM-EMF integrated into the EU law would make it possible to make more meaningful the building up of a stabilization function announced by the Commission, by making of a well-established borrowing capacity of the ESM a backstop, not only for the Single Resolution Fund, but also for the new instrument for macroeconomic stabilization. So this battle, I would call it, for the incorporation of ESM into the Union law will be a crucial one. And I expect and I hope that European Parliament and national parliaments will form a united front in it. These considerations brings me to the second function we need, macroeconomic stabilization. There is a broad consensus among experts of the fact that we cannot just have common monetary policy and national fiscal policy in order to absorb asymmetric shocks. And we know among the various options, I consider, there are many of them, I consider personally an unemployment benefit scheme of a rainy day fund for unemployment the best suited to perform the role of rapidly tackling the impact of a severe economic downturn while avoiding permanent transfers and preventing moral hazard. I understand that the Commission is reflecting on a mechanism of stabilization through public investment, which is also an interesting possibility, which we will discuss. Coming to the third function, economic policy convergence, the Parliament supports the establishment within the Union budget of such a function through the provision of support to structural reform. We have also proposed a convergence code which might define the targets of an enhanced economic policy coordination while leaving to national governments and parliaments the necessary discretion to define the policy combinations necessary to reach those targets. I note that new instruments in this respect would represent a far more meaningful and useful form of transposition of the Treaty on Stability, Coordination and Convergence in the Union law. I will come back in a few minutes on this issue, but I would like to underline that while the incorporation of Title III of the treaty, the so-called Fiscal Compact, article from 3 to 8, is, in my view, unnecessary and counterproductive, it would be very useful to focus on the Title IV of the treaty, the one not exactly on economic policy coordination and convergence, which calls, I quote, the contracting parties to work jointly by making use of the EU treaty provisions, like Article 136 and enhanced cooperation, start of quote, towards an economic policy that fosters the proper functioning of the EMU and economic growth through enhanced convergence and competitiveness. Budgetary support, end of quote. Budgetary support for economic policy coordination and also for giving additional pre-accession assistance to non-EU area member states, as the Commission plans to propose, is also useful. However, for the European Parliament, these budgetary tools can only be established on top of existing capacities and not through redeployments that would undermine the current fundamental role played by structural fund and cohesion policy. This brings us to the necessity of an ambitious multi-annual financial framework for the next cycle. We should make full use of the suggestion of the high-level group report on own resources, and in this respect, the provision of the above-mentioned functions and of other common goods that can be provided more efficiently at EU level, management of EU borders, sustainable development and investment, could be financed through the so-called earmarking of specific forms of revenues directly linked to common sectoral policies. As on the needs and the tools for enhancing financial integration through the completion of banking union CMU, we have already a clear roadmap. I would not elaborate on that, and will so finally come to the last function, the fiscal surveillance and coordination and the integration of the fiscal compact into the EU law. As I already said, while working on the Title IV of the treaty would be extremely useful because we don't currently have adequate instruments to provide enhanced economic policy coordination and convergence, the fiscal provision of the treaty, which are in Title III, which is called the Title III literally Fiscal Compact, are already incorporated into the EU law with the only very small difference related to the lower limit of the structural deficit for the balanced budget, 0.5 instead of 1%, but only for countries with high debt, for which in any case the MTO is calculated below 0.5, so no different de facto. What is not into the EU law is the obligation to incorporate in the national law the balanced budget and the correction mechanism, which, however, is already operational, and in this respect the fiscal compact has concluded its function. Moreover, it should be noted that Article 2.2 of the treaty clarifies that the treaty, I quote, shall apply insofar as far it is compatible with the EU law, which means that any amendment to the Stability and Growth Pact or to the EU treaties would automatically have legal supremacy over the fiscal compact provisions. All these elements tell us that the planned incorporation of the fiscal compact into the EU law might be defined neither particularly useful nor necessary. The only thing which would make sense would be to streamline the correction mechanism within the current flexibility provisions, which provide the Commission, as we know, with an indispensable margin of appreciation which is necessary to make the overall assessment, I quote now the six-pack, of a member state deviation from the MTO or from the appropriate adjustment path toward it, taking into account, in particular, is said, so not only, some criteria listed in the legislation. In addition to that, in order to provide any added value, this exercise should give the opportunity to discuss a broader reform of the Stability and Growth Pact in order to better incorporate into it the flexibility, differentiate the treatment of investments, introduce the concept of aggregate fiscal stance. Without these elements, I don't expect, honestly, that the unanimity required by Article 126.14.2, which I understand is a legal basis, because paragraph 3 does not seem to be an appropriate legal basis, would be required among member states. So I don't expect that without those elements, this unanimity will be reached. It is also important to clarify that for the Parliament, the European Parliament, it would be unacceptable any procedure which would not foresee a full participation of the Parliament as co-legislator through a double legal basis mechanism between Article 126.14.2, which is member state by unanimity, plus 121.6, which is the ordinary legislative procedure, the legal basis under which we did, for instance, the six-pack and the two-pack, on the basis of the package model, like the one followed for the SSM/reform of the EBA. Far more important, and I come really to the conclusion, appear a larger horizon that the Commission is expected to cover in its package. On the possible scheme for sovereign bond-backed securities, I note the assessment currently done by market operators, which find very challenging to identify a market for those instruments in their current form without a degree of mutualization that I understand would be very sensitive and controversial. On the creation of a permanent European Minister for Economy, we think that while this full-fledged function requires a meaningful fiscal capacity, whose creation needs time, it would be appropriate to take the opportunity of the renewal of the Eurogroup leadership for making use of the possibility of appointing a commissioner as its president. It is in our parliamentary report, which would strongly enhance the institutional streamlining of the EMU process and the democratic accountability at the EU level of that body. As you can see, the discussion is touching upon decisive points. And as an economic governance to be good has to be democratic at European and national level, I look forward to the dialogue and the cooperation between the European and the national parliaments and to the debate we will have in this important conference. Thank you for your attention.
Thank you, Mr. Gualtieri. Looks like we have like 35, 40 minutes for the interventions, and as I can see, there are 16 participants, so hopefully 17. We can hear all the views and thoughts that you have, and then we can also have the comments from the co-chairs and the keynote speakers. And first intervention from Spain, Mr. Pedro Saura, please.
Thank you. Thank you. Yes, I'm here on behalf of the Spanish Parliament. I'm also a member of the Socialist Party. And I'd like to share with you, my dear colleagues, my point of view. I think that this is the new normal. For us, for some of us, this is a new economic paradigm where growth is not enough. And for many different reasons, I will not get into those, but growth is simply not enough. Just let's think about this new social class, this new class of job insecurity, this insecurity that has some deleterious effects in many things, also in economic growth and on a mediocre productivity rate. So the welfare state should be at the center of our concerns, dear colleagues. And more than ever, the welfare state, not only for social and political reasons, but also for productivity reasons and for potential growth reasons. So I shouldn't be really going into the line of requesting more public deficit, more public debt, but let's get further into budgetary issues, fiscal issues, tax issues. Let's think about this as the new frontier for us. This is going to be contributing as well, if we work on this, to economic growth. We have a banking equality, then banking authority rather, and we would need a fiscal authority, European authority. So in the European semester, the fiscal indicators should be included, and the different reform plans of the different countries should also take into account our fiscal goals. So this is, and that's all. That's all for me. Thank you very much, Mr. Chairman.
Thank you. Next one is from European Parliament, Ms. Maria João Rodrigues, please.
This interparliamentary conference is happening in a very special moment because after this conference, key bodies will take decisions. The ECOFIN Eurogroup will come with proposals. The Commission will table a full package to reform EMU. And then we have the European Council and the Euro Summit on the 14th and 15th of December. So I would like very much this interparliamentary conference to send a strong message according to these lines. We believe that our monetary zone should be not only for stability, which is needed, but also for growth and upward economic and social convergence. And in order to deliver these, member states, they need to commit on a convergence code and delivering the necessary reforms and investments. But we also need to make sure that member states have similar conditions to invest for the future. And this means to complete the banking union, and this also means to build up a fiscal capacity, which I believe should be included in the upcoming community budget and counting on own resources. This is our window of opportunity to send such a clear message for the decisions coming very soon.
Thank you. Mr. Dimitrios Mardas from Greece.
I'd like to point something dealing with all elements related to the future design of EMUs. First of all, we have to respect all rules which are provided by PAC 6 and referring to the excessive macroeconomic imbalances. And I'm not referring only to the imbalances dealing with public deficit, but we have, in some cases, excessive surpluses. So we have to apply rules even in this case. Second, regarding the dominant approach, this is, I can say, an extension of Michel Gardieri's point of view. Regarding the dominant approach dealing with the economic policy which are applied in the context of Eurozone, there is a contradiction in the system. What is the contradiction? We need low deficits and debt, which means that we have to reduce public expenditures. This means that we will face a reduction in consumption and imports. If, however, we want to facilitate growth, we have to push investments and exports. In this case, we need a mechanism favoring, in the short run, liquidity in favor of the market, not in favor of the public deficit, but in favor of the market. And we have to work on that. Else this contradiction persists, and this may arise other problems. And finally, regarding the approach of Mr. Juncker of the 13th September 2017 about the qualified majority, the extension of this majority for certain taxation rules, this is written to this information document, background information document that you have distributed. In principle, qualified majorities, let's say European style. But however, we have to pay attention in that because in some cases, we have seen that through this qualified majority, we have seen the struggle of some sectors and we have seen contradictions between sectors and regions. I would like to remind you the case of small series cars and of vineyard in cases where we have, let's say, intervention in production in favor of the dominant forces and against sectors and regions which are not so strong. Thank you very much.
Thank you, Mr. Mardas. Mr. Norbert Brackmann from Germany, please.
Ladies and gentlemen, we are currently in a phase of economic upswing in the European Union. We're seeing a slight growth, but I am afraid that we are slightly mistaken when we believe that this will remain the case for a long time to come. Just changing the interest policy, or just if you look at the changes of the interest policy of the ECB, we will be faced with challenges. And the question is, how will we deal with this situation? It has been frequently mentioned here that existing treaties are not adhered to, or it was demanded that they should be adhered to, and we very closely look at whether the institutions in the European Union are successful in really achieving uniformity in the Eurozone or uniformity among all of the member states, or whether these institutions do not succeed. We look at whether the fiscal treaties really become integrated into EU legislation as agreed upon, or whether this does not happen. And with regard to the ESM, this means if we do not want to lose our resilience against shocks, we should not endanger the firepower that we have within the ESM, and it should not become integrated into the EU institutions, but it should remain under the responsibility of those countries in the Eurozone that have made these funds available in addition to the EU funds.
Thank you. And now over to my colleague from Estonian Parliament, Mr. Aivar Sõerd.
Thank you very much, Chairman. First, I would like to say that for the economic and fiscal union, the standing point is that we already have a remarkable governance structure in place. The previous economic environment is favorable. It's favorable for strengthening public finances of member states. We have to use the present supportive economic environment to make the rules work. It's also necessary to say that there is no way to escape the rules. We can improve the agreed current framework by implementing the existing rules more efficiently. It's fair to say that the full potential of European Monetary Union governance framework has not been yet used. Basically, we should do what we have been promised and in the framework of economic governance and do it well. Thank you for attention.
Thank you. And now a word to Mr. Christos Staikouras from Greece, please.
Thank you, Chairman. The crisis highlighted the need for better coordination and enhanced surveillance of budgetary, macroeconomic and structural policies. Therefore, the European architecture needs to be deepened, improved and strengthened in order to turn the monetary union into an efficient and transparent economic and monetary union. Which are the priorities? First of all, pursue in-depth, consistent and coherent reforms to improve structural competitiveness. Strong prioritization, administrative capacity, clear communication, well-designed benchmarking with the use of digital technologies are necessary to overcome resistance. Strengthen macroeconomic balancing mechanisms, operating in a symmetric manner to close investment gaps. Coordinate our economic policies, including a budget, allowing it to ensure stabilization and solidarity in the event of economic shocks. Adopt fiscal discipline rules, however, taking into account the economic cycle as being reflected in the fiscal compact. Setting realistic fiscal targets and implementing the appropriate fiscal policy mix are preconditions for sustainable public finances. Access to finance is crucial for businesses. A fully fledged capital markets union can expand and diversify this access, especially for SMEs. Finalize the banking union through the operation of a European deposit insurance scheme. And finally, I agree, establish a central fiscal stabilization mechanism. In this direction, the European Stability Mechanism could be transformed into a European Monetary Fund, and this fund will act as a lender of last resort for its member states. Thank you.
Thank you. Mr. Udo Bullmann from European Parliament.
Mr. Chairman, dear colleagues, I would like to appeal to our friends from national parliaments. If you would like to see progress in Europe, if you would like to see a flourishing economy that is able to master the future, then we all together have to refrain from a further renationalization of our economic policy instruments. It was explained by our chairman Galtieri that we have a functional added value if we do things together. We are very much ready to transform the European Stability Mechanism into a European Monetary Fund. But that cannot be done only by purely intergovernmental collaboration. The truth is, if you go for a purely intergovernmental procedure, you will not get more control, you will get less control. If there is anybody from our national colleagues who could declare that she or he has had a say in the Troika process, I will listen. Because this was due to bureaucrats, it was not due to national parliaments. And this is my pledge to Mr. Dombrovskis, to our Vice President. Do you stand ready to defend the community method when it comes to this transformation? And do you stand ready to defend the role of the Commission when an unfriendly takeover by the European Monetary Fund, or now European Stability Mechanism, is threatening when it comes to your surveillance capacity on economic governance, on national fiscal policies? I would be keen to get a clear message from the Commission on that. Thanks very much.
Thank you. Next one, Lord Desai from UK.
Thank you, Mr. Chairman. First of all, I ought to thank the Parliament here for having taken on the burden of UK presidency. Thank you for taking over what we failed to do. As a professional economist, I think it's pretty straightforward that given the structure of the European Monetary Union, there is very little scope for individual governments to do very much about macroeconomic policy. All that is left to do is what is called structural reform, which is entirely microeconomic policy. So I think that given the deflationary bias of the EMU, which is well known to economists, I think the best one can do is to create institutions at the federal level, at the European Union level, which will ease the burden. And here I think it would be very constructive, not just to do capital market union and so on, but create a fiscal mechanism at the European Union level, a slightly larger budget, which would make it easier to make transfer payments among the different countries. I know this is not a very popular thing to say, but I think that is needed. For the last few years, we have had recovery, but that's entirely because of a loose monetary policy followed by the ECB. A strict fiscal policy with a loose monetary policy can get you growth. The loose monetary policy is going to stop very soon, and the difficulties are going to be multiplied unless a better fiscal policy is designed at the union level. Thank you.
Thank you. Mr. Paulo Trigo Pereira from Portugal, please.
Thank you, Mr. Chairman. I'd like to start with three basic ideas. The first one is that there is a time to take essential and crucial decisions for improving the economic and monetary union. And if the so-called right decisions come too late, they are not right anymore. I'm thinking, of course, in banking union, for example. The second idea is that the essential problem of governing the EMU is not the lack of rules and procedures, but the lack of instruments to achieve objectives. The Stability and Growth Pact, Two-Pact, Six-Pack, and the Fiscal Treaty, the macroeconomic imbalance procedures have already many rules. They supervise very well countries, but then we have no instruments to achieve that. I can ask, for instance, what instruments has the Commission or the Council to correct for macroeconomic imbalances? For example, to correct for external surplus of some countries. The answer is none. I can ask, how can the Commission or the Council implement a desired fiscal stance? How can it implement a moderately expansionary fiscal stance? The answer is it cannot implement any fiscal stance. So the third idea is that we should move from intergovernmental decision-making to more democratically accountable community decisions. So since I don't have much more time, I conclude saying that including the fiscal compact within the treaty is a big step, will not solve any major problems of economic and monetary union, and it would be difficult to approve in national parliaments in some countries using referenda. We should go in small steps on banking union, fiscal capacity, for example. Thank you very much for your attention.
Thank you. And now I will give a word to Mr. Igor Pimenov from Latvia, please.
Thank you, Chairman. Concerning the incorporating of the Treaty on Stability, Coordination and Governance into EU legal framework as the Article 16 of the treaty stipulates it, the lessons of the last year should be taken into consideration. It is to define that the control of budget deficit need be combined with the use of mechanism of flexibility admitted in the Stability and Growth Pact. It is the flexibility of that which gives space for initiatives for more investments. Even if the integration of the Fiscal Compact and the Stability and Growth Pact does not happen, significant revisions are needed to be implemented within the EU legislation. First, the calculation of potential growth and thus of the structural deficit should be based on a considerably longer time gap than 2 years, which is used now. Second, the methodology for determining of the structural deficit should be reconsidered. This rather academic variable is hard to calculate and can cause mistakes which cost much for member states in future. A solution could be to replace structural balances with an expenditure value. In contrast with the structural balance, the expenditures can be controlled easier. And third, the flexibility of the Stability and Growth Pact should be extended, in particular by exempting national co-financing of EU structural and investment funds programs from deficit calculations. National economies need public investments in order to raise internal demand. For private investments to come, the public ones should be provided first, as the private follow the demand. Thank you, sir.
Thank you. And now Mr. Marios Mavrides from Cyprus, please.
Thank you, Mr. President. The Eurozone is not just a group of countries that share a common currency, and it is not just a group of countries that must follow the same rules. Eurozone is a group of countries that share the same vision, which is a fully integrated economic and monetary union that is sustainable and long-lasting. The Eurozone today consists of countries that have different amounts of debt, different internal goals and different priorities. Low debt countries have an advantage and high debt countries have a disadvantage in trying to pursue their economic policies to balance their budgets and achieve economic growth. I believe that Eurozone rules are now much better than before, but they focus more on budgetary considerations than on reforms, which are necessary to achieve long-term economic growth and prosperity. That is why I believe that the European Commission should put more pressure on member states to implement economic and social reforms in order to achieve economic growth and stability. I also believe that the Eurozone members could achieve sustainable growth and long-term stability and social cohesion by focusing more on the private rather than on the public sector. Less government and less public spending and also less taxes will boost investment and consumption, which will be translated into economic growth. Thank you.
Thank you. And now Mr. Eric Vert from France.
Merci, Monsieur le Président. Sur le plan européen, comme sur les plans nationaux, il n'y a pas de bonne finance sans stabilité.
Thank you very much. So if we look at the level of every member state, we need to be flexible. First, I have a comment, and I would like to know what is the opinion of the Commission and the Parliament regarding these two possible bubbles. So one is the global debt level, and the second will be the value of assets. So if we talk about the stability mechanism, then we have a question: how can we handle this new shock? And second, the stability doesn't happen without a good level of income. And here we have seen a lot of aggressive optimization in different companies. I give you many examples in the field of IT, for example. Do you have a timetable perhaps in place? So can you indicate steps of progress, or can I hope there will be progress when you look at the EU institutions and our future regarding the corporate income tax? I can see that never it has been a suitable condition to achieve convergence here. Is it possible for us to move forward in the corporate tax field?
Thank you. And I will remind you that the comments from the co-chairs and the keynote speakers will come after the interventions. So we will have 5 last interventions, and then Mr. Dombrovskis and Mr. Gualtieri and Mr. Ligi can add some comments. And now Mr. Antonio Misiani from Italy.
Grazie, Presidente. Thank you, Chairman. The economic crisis has stressed limits in the functioning of the Economic and Monetary Union, and the euro was saved by the European Central Bank, and surely not by the Fiscal Compact. And the debate on the future of the Economic and Monetary Union should be an opportunity to overcome these problems, these challenges, and to be better equipped when we will have to face new shocks, new difficult moments in the future. The Italian Parliament has discussed many times this problem. The Chamber of Deputies has passed a motion urging the Italian government to adopt certain stances with respect to the economic and monetary reform, and the Parliament would like to see, the Italian Parliament would like to see a reform of the governance so as to focus more on creating employment rather than rebalancing public accounts, which was the dominant approach over the last few years. And this entails the revision of the calculation methods and the macroeconomic stabilization mechanisms. And then there is an issue of greater coordination among European institutions, starting with the Commission and national parliaments. And in this respect, I believe this discussion is very important, but we need to strengthen this coordination, and failing a wide-ranging review, an overall review of the overall approach of the European Monetary Union governance and the Fiscal Compact, the Italian Parliament, by a large majority, believes that it would not be ideal today to make the Fiscal Compact part of the legal framework of the European Union, and we believe that the political conditions to make this are simply not there for the time being. Thank you.
Thank you. And now Ms. Skevi Kutra-Kukuma from Cyprus.
The European Commission has recently announced 5 alternative scenarios on how the European Union is moving forward. The scenarios are based on the rationale of neoliberal austerity policies that led to a European Union of multiple speeds, split between the rich euro core and the poor periphery. All scenarios regarding the future of the European Union focus mainly on the deepening of the single market and trade and economic relations. The cooperation between EU member states is not based on the principles of solidarity and social cohesion. Neoliberal policies of harsh austerity measures and memorandums led to the collapse of social provision, the deregulation of labor relations, the dramatic increase of unemployment rates, risk of poverty and social exclusion. The same applies to the case of Cyprus, despite the country's exit from the macroeconomic adjustment program. Indicators and numbers are prospering while people are suffering. Inequalities still remain. The risk of poverty and social exclusion have increased, reflecting the deterioration of social conditions during the crisis. Unemployment declined, but still remains high. Low-paid and insecure labor is rising. Indicators of the risk of poverty and social exclusion have worsened. Wages are constantly decreasing, and the number of working poor is increased. Despite the disappointing conclusions about the social situation of the Union of the 5 Presidents' report, the European Union continues with the same neoliberal recipes. Unfortunately, the good intentions of the European Commission as regards the 5 scenarios for the future of Europe, they remain empty words and rhetoric declarations. In such conference like the one we are here, where MPs from national parliaments participate, the social aspect of EMU should put before and give more emphasis on that. Thank you.
Thank you. And now Ms. Margarida Marques from Portugal.
Muito obrigada, Presidente. Merci, Monsieur le Président. L'intégration du traité dans le cadre juridique doit être, à notre avis,
Well, if you think about the legal integration of the member states, I believe that before that we should see some very serious assessment. We have a 5-year experience of a period which has been a great challenge for us. It has been a sufficient time for us to carry out assessment. We have to take into account the aspect that flexibility which has been brought in has been helping us to apply our possible systems better, and it has been a great assistance for Portugal. We have been taking great advantage of flexibility. Here we can see this kind of vision, which is actually in contradiction with the principle of public sector investments. We have to develop these kind of conditions where we have situations where we can develop further the public sector investments. At the same time, we will need to review certain terms and principles. For example, if you look at the structural deficit, and we need to review certain calculation methods. This is an agreement on coordination, on governance and economic coordination. Our aim is to achieve a greater capability of democratic oversight. This is not only stability, but also convergence and economic growth. We want to achieve our economic objectives, but also we should not neglect the social objectives. Strict discipline in budget has to be coordinated with the general capability of the EU budget. Thank you.
Thank you. And now Mr. Stefan Radu Oprea from Romania.
Thank you, Mr. President, dear colleagues. First of all, I would like to thank our host for the openness in sharing the experience in organizing the Estonian presidency, because if you may probably know, the Romania will be in this position in the first semester of 2019. The provocation that we will face together, Brexit and the Euro parliamentary elections, will give a special dimension to our presidency. In this respect, we believe that the outcome of the white paper of the future of Europe and the reflection paper of the economic and monetary union should be the adoption of measures leading to a real enforcement for all member states. Moreover, the undertaken measures should have a contribution to cutting the red tape on the level of European institutions. We welcome President Juncker's proposal during his speech on the State of the Union to reinforce the EMU based on the inclusive and transparent approach towards both the euro and non-euro member states. Romanian will is to join euro area when the economical criteria will be fulfilled. Therefore, we welcome Commission initiatives to offer technical and financial assistance in integration perspective. We support the need for simplification and transparency of European rules to support member states in reducing development gaps and boosting the economical growth. However, we are skeptical about the benefits of establishing a direct link between country-specific recommendations and funding from the community budget. A budget architecture with a separate euro area budget could have an impact on traditional policies, common agriculture policy and cohesion policy, which are essential for reducing disparities between member states. We therefore believe that setting up a budget dedicated to euro area would increase the economical divergence between the member states of the European Union. Establishing a macroeconomic stabilization function can add value to the process of economic policy coordination at EU level. Such an instrument will, however, be difficult to set up given that the net contributing member states to the budget scheme of stabilization will have a favorable macroeconomic situation and therefore will not resort to the mechanism, will be dissatisfied. For this reason, setting the details of such a possible instrument will be a delicate process. And finally, a personal remark. 2 weeks ago, on Econ reunion in the European Parliament, we discussed the same subject. And one of the objectives defined was the 3% growth of the European economy. This indicator is an average, so Romania, which will finalize this year with the 6% growth, despite the initial pessimistic Commission forecast, is one of the net contributors in this respect. I hope that through solidarity and wisdom, we will find common solution which will allow the states with accelerated development potential to reduce the economical gap, and in this way, the economical migration issue to be overcome. Thank you.
Thank you. And the last intervention comes from Mr. Jörgen Andersson, Sweden. Please.
Thank you, Mr. President. I could not resist to make some personal reflections listening to my colleagues. And I listened to them, them putting a lot of confidence to steps towards federalization. And I do recognize that capital move fast and see no borders. And for that reason, one can recognize you need surveillance and legal frameworks that is common and synchronized. But that does not mean that we need federalization. I listen to my colleagues and they put a lot of effort into that, even when it comes to growth and to making jobs. And maybe you could bear with me bragging somewhat when it comes to Sweden, because we are not part of the Eurozone. Even so, we have quite good growth and we have job creation that is quite good as well. So we need to figure out why the growth is not accelerating in the Eurozone. And let me also remind you that we have a massive stimulus from the monetary policy and still the growth hasn't been what was expected. And I do not believe, or at least I'm not convinced yet, that steps toward more of federalization would solve that problem. So I think we need to dig a little deeper and try to discuss more of the internal markets and trying to prevent protectionism and trying to cheer for free borders without any more of federal steps. Thank you.
Thank you. Thank you all for your comments and remarks. And now I will give the floor back to Mr. Dombrovskis for the comments, and then Mr. Gualtieri, and then Mr. Ligi, please.
Thank you, Mr. Chair, honorable parliamentarians. First of all, thank you for your remarks and also questions which have been addressed. Let me try to come back to this through the four guiding principles of the deepening of EMU, which I had been describing during my speech, because I think most of your interventions were touching upon some of those guiding principles. So first, there were lots of questions on convergence and whether the steps which we are taking are indeed fostering the economic and social convergence within EMU and within EU. And this is indeed one of the tests where we need to test all our initiatives to see whether indeed they are facilitating the convergence. Second question, which was often coming from different angles, is whether we need to concentrate on risk sharing or solidarity or risk reduction and responsibility. And that's why I was emphasizing that the initiatives on risk sharing and risk reduction or solidarity and responsibility should go hand in hand. Only this way we can find a balanced approach. Third, which came from some colleagues, is a relation between euro ins and outs. And that's why we emphasize so much that the work towards deepening EMU should be open and transparent to non-Eurozone countries, that it should not undermine the integrity of EU single market, and that the EMU should remain open to all EU member states. So those are the principles which we need to follow. Then on some of the more specific questions which were raised, just very quick reactions. So first on the question of community method and integration of Treaty on Stability, Coordination and Convergence in the EMU, and integration of ESM into community framework. Of course, as European Commission, we are supporting community method. So that's why we are advancing those initiatives, and we believe that both the Treaty for Stability, Coordination and Governance, including Fiscal Compact, should be part of the EU framework, and also when moving ESM, when developing ESM, it should be part of EU framework. And to come back also specifically to the question of Mr. Bullman, of course it should be done within with the respect of institutional role of institutions, including the role of European Commission as enshrined in a treaty and EU legislation. Then on the some of the specific questions on the Stability and Growth Pact, the use of flexibility. Indeed, as you know, we had come already in 2015 with a communication on best use of flexibility within existing rules of the Stability and Growth Pact, which includes investment clause, which exactly addresses the issues of EU co-financed investment, including structural investment funds or cohesion funds, and in a context of simplification of application of rules, we are now indeed moving more towards the use of expenditure benchmark. Then on the question which was specifically raised on corporate income tax, we believe we can make progress and we should make progress. European Commission's proposal on common consolidated corporate tax base is with co-legislators. I hope we'll be able to move forward, and also more recently we are actively working in a field of digital taxation to ensure that also internet companies, including internet giants, pay their fair share of corporate tax where their real economic activity is taking place. Well, once again, I would like to thank you very much for your comments, and indeed this conference comes in a very timely moment before we are finalizing our work on our European Commission deepening of EMU package for 6th of December, and before leaders are moving towards also decisions on future of EU, including completion of EMU. Thank you very much.
Thank you, Mr. Dombrovskis. And now, Mr. Gualtieri, your remarks.
Thank you. Thank you very much for your very important remarks. I would say, I would start, kindly expressing some disagreement with the colleague from Cyprus that the last said, okay, we had a long phase of purely neoliberal policies. I think we need some differentiation. I think that we had a first phase where indeed there was a very much emphasis on austerity. I think we need to recognize, then some of us cannot consider this enough, but this is that since 2014 the Commission has put into place a more balanced policy mix, and exactly this is my view, one of the reasons why the results are better than they were before. So I think it's not appropriate if we consider without sub-distinction what is the period bit behind us. So the colleague from Sweden would say, okay, why the growth is not so good? First, I would not be so negative. I mean, the results of the recent months are quite encouraging. Of course, as I try to say, I agree with you then, we are facing some major structural challenges. There are those who talk about, let's say, a more secular stagnation. So there are problems which are not of cyclical nature and which are related with the nature of some transformation. Let's talk, for instance, a colleague from France, Mr. Wirth, make the reference to the aggressive optimization of digital industries. This is true, but what is more striking that we have this wave of technological innovation which seems more focused on what economists call process innovation than more product innovation. So de facto we have the cons of cutting labor force, but not, on the other hand, like we had in other historical eras. Let's say when there is a disruptive transformation, we have, okay, creation of new category of product. So we have an innovation which is at the end a bit unbalanced and have on the other hand, a huge impact on our labor force, but also of our tax collection capacity. And that's why I strongly agree with what has been said and why the Parliament is so strongly committed, for instance, but I understand there will be a session dedicated to that, for instance, on approving the CCCTB and adapting this for especially for the digital environment by means of a digital presence amendments and so on. And we really look forward also in this to the cooperation with national parliaments. So in order to address these double challenges, which is a cyclical and a structural one, where really we need to improve our not just competitiveness and productivity, but our innovation capacity while keeping together the society and safeguarding our welfare state, we really need an improved leap forward in our governance quality. I personally, for my political orientation, I fully sympathize with the comment with those who emphasize the need for an improvement of our, for instance, fiscal rules in order to make them more investment friendly, to be more precise, as Mr. Pimarov, I guess, said, to address, to solve a number of problems that they shown in not fully measuring the growth potential, the output gap, and I agree that going more nominal, going more for expenditure, benchmark might be a way to do that. But this shows also us, as many said, that, as I said, I find very difficult that we can honestly have a part of what everybody of us think about politically and a simple incorporation of fiscal component in the rules. So either we open a debate on a revision of our rule, an improvement that I understand is not an easy thing, or I don't simply think this thing will fly. And so I invite the Commission to reflect on that. And finally, I think that in order to make more balanced or different needs, because we have to recognize also politically that we have different views, and at the end we need to make big trade-off, a compromise, which needs to be not only political, but also for the sake of the quality of our governance. We need, yes, more investment. We need more convergence and more reform. We need more risk sharing. We need more risk reduction. We need more social cohesion. We need more single market. We need more better rules for our international trade in order to better safeguard our industry. On the other hand, we need more trade deals. That is at least my view. We need more taxation for the digital multinationals, but we need also, hopefully, to reduce the tax level of work and industry. So these are the big trade-offs that I think would make the basis of a deeper EMU. But this, and this is a final message, I think, if we want to have this trade-off and this political parliamentary debate, we need to go through the community method. This is the only way. That's why I insist on what I said. I'm happy that also Mr. Bullman reiterated the concept. We need to make an alliance among us. The ESM incorporation will be the first of these. We need to, not just because with 352, both European Parliament and National Parliament will have a say. With just a reform of the treaty, neither of the two will have a say. This is a purely, let's say, bureaucratic argument. It's more political. If we want to build up this kind of political, economic, geographical trade-off to make our governance better, we need to parliamentarization of the process. And this requires community method, a strong alliance between national parliament and European parliaments.
Thank you, Mr. Gualtieri. And now, Mr. Ligi, your comments.
Thank you. Thank everyone for the interventions. I would contend with only a couple of them. First, fiscal rules have never been the reason for crisis. They have been a conclusion of them. And we shouldn't talk so much about or against austerity. This is something that that makes our expenditure affordable. And second, of course, crisis has its social dimensions, but don't forget that very much one of the reasons of debt crisis was too expensive and too ineffective social policies. And second, don't forget that several creditor countries have had lower social standards. I told it already, than those program countries who have criticized here the austerity programs and loan or aid programs. So there is a social dimension. My conclusion is actually that the deepening of our monetary union should go towards better implementation and better supervision of the rules. Thank you.
Thank you. And thank you all the speakers and the participants for this constructive and fruitful discussion. Before we move to the coffee break, I would like to point out that we have two exhibitions in the building. Firstly, the e-Estonia showroom. You can find it from the first floor, and you can see the successful e-Estonia examples from there. And the second exhibition is also on the first floor, and it's from the Central Bank of Estonia, and it shows the currencies and banknotes that Estonia used before euro. And also, hopefully you saw that there is one a delivery robot on wheels that actually offered you some candies. The candies are made for the anniversary of Estonia, because we are celebrating 100 years anniversary next year. So this is a Starship technology company, which is Estonian one, and this robot, I mean. So feel free to take some candies and take a look at this robot as well. So before the coffee break, I have one big thing to ask from you, to make the traditional family photo. So please follow our staff, and then we will do the photo, and then I hope to see you all back 4:30, so we will continue with the second session. Thank you. Dear colleagues, I hope you enjoyed the coffee break. We will continue our conference day with session number 2, and we have also 1.5 hours for it. In this session, we will discuss some of the stability and growth measures like national reforms, financial assistance, and investment programs. And I realize that it's a really broad topic, so hopefully we can cover at least a part of it. The EU has implemented measures to boost growth by encouraging investments, restoring trust in the financial system and dealing with structural issues. This was done through better coordination. Financial assistance, capital requirements, and better supervision are working, and the final goal of a banking union is set. Financial support to the member states has been conditional. Comprehensive fiscal, structural, and supervisory reforms have been implemented in the recipient countries. However, it would be possible to achieve a better result by improving the coherence between programs and instruments and by simplifying their functioning. So we will discuss over these ideas. For example, what can be done to achieve convergence and coherence of EU financial assistance measures? What incentives could be assured the implementation of structural reforms in member states? And should the link between European semester and EU financing be strengthened? Should national reforms be rewarded? Let me introduce our distinguished speakers for this session. First keynote speaker is Mr. Ardo Hansson from the Estonian Central Bank. Second keynote speaker is Ms. Mari Kiviniemi from OECD. After the keynote speeches, I will give the floor to the session's co-chair, Mr. Roberto Gualtieri from European Parliament, but you already know him. Both keynote speakers will have around 15 minutes to make their speeches, and then we have 45-50 minutes for the debate. And just to remind you that you can already sign up for the interventions and remarks and questions, just pushing the button. So I would like to warmly welcome our first speaker in this session, Mr. Ardo Hansson, the governor of the Estonian Central Bank, which is a member of the European system of central banks. Mr. Hansson has also worked in the World Bank and is a highly regarded Estonian economist. Mr. Hansson, the floor is yours.
Thank you, Mr. Holzer, and good afternoon, ladies and gentlemen. I'd like to, first of all, thank the organizers for a very diverse program focused on very topical issues, and thank those of you who traveled far and wide to attend this meeting. Maybe it's been discussed already. I'm sorry we couldn't organize better weather for you, but it's not like this all the time. This is the worst I've seen in a long time, which makes it maybe more productive to stay inside. It goes without saying that you as parliamentarians have or will have and should have the final say on many of the issues that we discuss. We in Estonia, I think, want to be part of these debates, even beyond our presidency-related current role. And I think we've always tried to be an active, constructive, pro-European voice. And if you look at, let's say, the euro area, and there's this Eurobarometer survey that says where is the euro most popular, I think it's always either Estonia, Luxembourg, Ireland, or Slovenia, which are competing for top spots. So this is one of the most pro-euro places on the continent, and we have a particular interest in making sure that that works well. I think also that I think broader, not only Estonia, but in the Baltics have a fair bit to offer. I think every country's track record is far from perfect, and we have had our major issues, boom-bust cycles and so on, which we haven't always controlled. But I think our overall track record has been very strong, both as concerns economic growth. There was a recent ECB bulletin which looked at the Baltic states as in a kind of annex, and if you look at some of those growth performances of average growth being 4 or 5% for 15 or 20 years, I think that is something that is consistent with what we're trying to achieve. And the second issue is then resilience in terms of responding to and resisting shocks in ways that the economy continues to function. Macroeconomic policy is sustainable, fiscal space is maintained, and we can solve our problems while not burdening others as little as possible. And I think if you look far and wide in Europe, this is the same picture that emerges. You take any issue and you look at World Bank indicators, OECD ratings, you look at World Economic Forum or those types of bodies, you'll always find European countries at the top of almost any one of those charts, which I think means that the fact that we're part of a common union is in no way a hindrance or it doesn't make it impossible to do a lot of things. It's actually, maybe it discourages at times, but it's certainly, many countries have reached the top of any kind of chart working in this environment. So I think that has to be borne in mind. To me, the topics of discussion for the second session really boil down to one question: how to help governments do what they have to do to make the economy work better. Now, definition of structural reforms, I guess this is a broad term. We think of steps, various policy changes, institutional strengthening towards two goals. One is raising the growth potential of the economy, and second, to improve the resilience of the economy. And I think we used to call this just improving economic fundamentals. I think at the outset of the EMU, it was expected that giving up the option to change exchange rates and interest rates on a national level would increase the incentives for reform that improve productivity and resilience. By removing the exchange rate instrument, then we had no other choice but to make our product and labor markets very flexible or more flexible and resilient. Now, 20 years later, I think we have a very credible monetary policy framework, and we're seeing deepened financial integration. But I think in two areas we have experienced problems. One is slackening of productivity growth, as many national governments haven't really pushed through many of the reforms that could be pushed through. And if we look now at the current developments in the euro area, we see growth of about 2.2% a year, but the problem is really not so much in a low level of demand, but we see a structural, if you look at measures of potential GDP growth, some of them say 1.2% a year. That's pretty poor performance that we shouldn't accept. So we could have a stronger baseline. And the other issue is then insufficient resilience related to lack of fiscal space, the distribution of that fiscal space over countries. I think we've had an issue before with bank capital, which now is much better. Generally, having more equity and less debt in the system is going to increase the resilience of our economies and increase the shock-absorbing capacity. The cyclical recovery and supportive financial conditions present now are a kind of window of opportunity. At the last IMF meetings, this was the central theme, to talk about this window of opportunity. I don't think it's something that opened up a few months ago. It's actually been there for a few years with all of the policies that made, let's say, interest rates as low as they were. But it's a window to push through reforms both at the EU and euro area levels. But why is it that several reports, let's say by the OECD and ECB, so on, conclude that the reform drive has been declining in the past couple of years? One issue is an issue of lack of ideas, and I think the answer to that is no. We need ideas, we need political will, and ideas come from knowledge of best practices in economic policy, either from the Commission, from OECD and other international bodies. And second, we need political will to follow through with reforms that may be costly economically, financially, and politically. And I think there's no lack of information, both country experiences and academic research of what works and what doesn't work. There's a lot out there, and I think national authorities and institutions are often best placed to work out and collect those ideas and try to make them work in their national settings. And then international institutions can provide good recommendations. However, the country-specific recommendations have not always been taken on board. And I remember pie charts from 1 or 2 years ago when we looked at all of the EU reform recommendations and how many had been implemented. And I think there was a 4% sliver that said these are reforms that have actually been implemented, and the rest, the other 96%, were either not implemented or partially implemented. So the track record is slow. There may be some of the countries that made progress when they were under formal programs. Then it's maybe easier to push through some of the reforms. And I think our country is no exception. When times are bad, we sometimes did more than when times are good. So this window can open, but it's sometimes tricky to make use of it when the pressure is suddenly suddenly gone. And I think so we shouldn't raise expectations too high with this window of opportunity narrative. Whereas the divergence in policies to meet the accepted targets may be perfectly understandable, I think the advisory capacity of these institutions is not always put to best use. Next question then, is it because of a lack of money? I've often heard it said that EU or national fiscal rules and the burden of recurrent public expenditures don't leave enough maneuvering room to finance structural reforms. It depends. I think there are some reforms that you need to do precisely because you're spending too much money on certain areas, and maybe having this kind of pressure actually build is the moment when you can deal with large inefficiencies in public spending, for instance. However, there are other reforms that have no cost to the government budget, so there can be no link between having money or no money and reform performance. And I think also the flexibility in implementing the Stability and Growth Pact delivers at least some relief in the case of structural reforms. And of course, there may be some reforms where you do need upfront cash, and it actually is a problem that you don't have, that you have limited fiscal resources. So I think it's hard to generalize. Political cost may be significant. The gains and losses from reforms are often unevenly distributed across the economy and over time, and people can be influenced by small but politically powerful agents who fight to preserve their privileges and so on. So the existing resources, I think, could be used better. And I argued before that the advent of the euro did not turn out to be the kind of reform stimulus that it was expected to be. In fact, it has been, in many cases, it has been quite the opposite. And I think the euro has supported capital inflows and borrowing that has made borrowing cheaper for governments. And there may have been a time in the past when you made mistakes, you paid yourself for them. And now when there's a bigger kind of there's a safety net which damps the signal between maybe not so good policies and the price you have to pay. So there may be reduced incentives to reform in some cases because of this structure that otherwise has many positive features. I think one example of how softer budget constraints can reduce incentives for reform is the existence of persistent and large productivity differences even within many of our countries. And I think regional differences have persisted for decades, even though we have many of the countries have made large transfers to these regions for a considerable period of time. And there may be very other reasons why GDP per capita, let's say, differs within countries, but it may be that in certain cases having large transfers may have had a negative impact on regional long-run productivity growth by reducing the incentives for change. All to say that I think it's tricky to construct these formulations that will ultimately unlock reforms, and that weakly designed financial assistance between member states might be counterproductive. So improvement possible, but not forgiven. And I think the background paper for today's event addresses another important issue. It appears that there are too many rules and regulations that apply to the current financial instruments of the EU, and I think their complexity may have become an obstacle to their efficient use. And according to the experience of some of the new member states, EU transfers tend to peak 2 or 3 years after the start of the multi-annual framework. And this can mean that there are rigidities in the system and can make it somewhat pro-cyclical. And we face that now in our own country, that we had the last 3 years actually where the use of some of these EU funds was actually quite slow because new projects were being prepared, we were taking our time, and now suddenly these projects are all prepared, they're ready to take off exactly at a time when our economy is taking off by itself. And rather than helping us to smooth this, to combat volatility, it's actually exacerbating the volatility because these monies are on their own cycle. In September, the informal economic ECOFIN gathered in the same building, in the same room, to discuss the way forward to a more integrated EMU. And I think there was a broad consensus that the new framework should be more supportive of reforms. And I think views on the details of the solutions varied, but to me the key arguments were over the role of the European institutions in promoting reforms and over the list of responsibilities that should remain at the national level. The current role of the central institutions regarding structural reforms is twofold: applying the Stability and Growth Pact and macroeconomic imbalances procedure, and then proposing country-specific recommendations. And I think this kind of framework is a good starting point for the coordination of structural reforms. A couple of years ago, a new instrument, the Structural Reform Support Program, was initiated. This program coordinates and provides country-specific technical support to all EU countries, and I think such support reinforces the reform capacity of EU countries by combining national ownership with expertise of the European Commission, a very nicely balanced fit. The Commission's recent reflection papers introduced the idea of reinforcing the link between national reforms and EU funding, or suggesting that there could be financial rewards for structural reforms. Although I know that currently there's a rule that countries that violate the Stability and Growth Pact may lose access to EU funding, but this has been very difficult to use in practice. So the threat of sanctions doesn't always provide the right incentives. And I think if we would reverse this process and say countries that make progress get more money has its own set of challenges. Which structural reforms are we going to reward, and what is the price tag for each one of these structural reforms? Moreover, as this decision is not made at the national level, it's likely to increase the democratic deficit in the European Union. So now we're waiting for new proposals by the Commission that are expected to include establishing a stabilization instrument, a Euro area Minister of Finance, and special budget line for the Euro area. I think in the best case scenario, these innovations may support structural reforms by overcoming the political obstacles typical at the national level. However, we must be careful not to weaken national responsibility by delivering new powers to the EU or the Euro area, because there are some reforms for which the responsibility should remain at the national level, while others require coordination. I think and largely dependent on the existence or not of material cross-border externalities. I think it's natural that the responsibility for long-term economic and social outcomes lies mainly with the national authorities. Euro area countries are different in many ways, and I think they should have the right to tailor their policies to their own conditions and preferences. And the primary responsibility for providing this information on the trade-off could rest with the national authorities, who are able to identify their country's needs and opportunities. And this information could then be presented to the public in the form of reform targets, timetables, and cost-benefit analyses. At the same time, the European level has the main responsibility for enhancing and completing the banking union, capital markets union, single market for services, and so on. And the smooth functioning and resilience of the euro area requires reforms that foster private sector cross-border risk sharing via financial integration. And I think it's important to increase the incentives for banks and private investors to hold a diversified portfolio of assets from several euro area member states. And cross-border risk sharing is particularly important for countries in a monetary union. And one option that has been suggested is creating a public stabilization instrument intended to smooth the cyclical developments on a national level. And we know that effective stabilization at a national level is much easier if public debt is kept moderate and fiscal positions remain strong. It's the duty of national authorities to strengthen automatic stabilizers, and they should also improve the ability of the private sector to manage shocks. Several research papers indicate that private cross-border risk-sharing channels are much weaker in the euro area than in, for instance, the United States. And private risk-sharing looks especially promising because of the sums involved can be quite large compared with the amounts the governments are ready to allocate at the EU level. So to conclude, we have to overcome the resistance to reforms. The appetite for reform could be supported by well-designed and time-consistent incentive mechanisms at the EU level. We need to improve the framework of governance, but it's important to keep the system of incentives in balance. Rights bring responsibilities and vice versa. The Commission proposal seems to be mainly on the side of positive financial incentives, but I believe in parallel we have to work on strengthening market pressure in the system. Thank you.
Thank you, Mr. Hansson. Our next speaker is Ms. Mari Kiviniemi, the Deputy General of the OECD. In the OECD, among other topics, she is responsible for the strategic oversight of the OECD's work on efficient and effective governance. Ms. Kiviniemi has been a member of the Finnish Parliament, where she has chaired several committees. She has also held several ministers' portfolios and has served as the Prime Minister of Finland. Please, the floor is yours.
Thank you, Mr. Chair, Mr. Holzmann, Mr. Gualtieri, Governor Hansson, ladies and gentlemen. Happy to be here with you and share the OECD's view on structural reforms, what should be done in your countries and also at the, together at the European level. And thank you very much for the Finance Committee of Riigikogu and the Parliament of Estonia for inviting me to this session. And you, as members of Parliament and members of the European Parliament, really have a crucial role when it comes to designing, delivering, and also implementing policies in your countries. And it is not an easy task to find the best policies and the best ways to implement the policies. But there the OECD comes to the picture. We offer policy analysis and advice, benchmarking and sharing best practices, and that is exactly what I'm going to do now. I will focus on the OECD's views on the reform priorities in Europe and highlighting the particular importance of sustained momentum for investment and picking up the pace concerning structural reform efforts. But let's start with the good news. As you see here, we finally have good news globally, as well as in European Union countries. We have even some signs that our economies may finally be escaping the low growth trap. So the global economy is now growing at its fastest pace since 2010, facilitated by policy support, accompanied with solid employment gains, and a recovery in trade growth is following now slumps in late 2015 and early 2016. So as you see here, September OECD interim economic outlook shows that global GDP growth will be about 3.5% this year and about 3.7% next year. And in the euro area, growth is now more broad-based, and it is likely to average close to 2% per annum this and next year, thanks to accommodative monetary policy, a mild fiscal easing, rising employment rates, reduced, to a certain extent at least, political uncertainty, but of course some challenges remained. Problems from weak credit growth and sizable non-performing loans have eased, but continue to be constraints in some countries. Here I come to the same message with Governor Hansson also had when it comes to investments. The improvement in growth really is welcome, but policymakers must not be complacent. The effects of prolonged subpar growth after the financial crisis are still present in investment, as you can see here, and it's also present in trade and wage developments. So the investment recovery has been very weak compared to other recoveries in earlier years. And also when you have a look at the investment shortfalls falls by countries, you see here in Italy, Germany, France, and also UK, that more investment really are needed if you want to have a look at the long-term need. And the same challenges are accentuated when looking at investments at the regional level. Subnational governments in EU countries in OECD account for 52.6% of total public investment. And across all EU countries, subnational public investment has decreased by almost 18% between 2009 and 2014. And this means about 5% per year in real terms. And while in 2014, public investment at the central government level seemed to be slightly recovering in the EU, public investment at the sub-national level nevertheless declined. So this low investment rate is not the only bad news. In addition to that, productivity growth has been weak during the crisis, and this has come on top of a rapidly aging population. So combined, this would reduce the long-term growth potential of European economies. And when we dig a little bit further or deeper to the productivity development, we can see here that productivity gaps have widened, and that has, of course, led to wage inequality or increasing wage inequality in OECD countries. So we have in all the EU countries and actually at the OECD countries, firms which are performing well. The productivity development in those is very good, even excellent, but then we have the non-frontier firms where the development is much worse, as you can see here. And also when we go to the regional level, here kind of the same phenomena as when it comes to investments. The same challenges are accentuated when looking at the regional level. So the productivity divide we see across firms, we also see here across regions in the same country. And the last OECD regional outlook highlighted that this divide between frontier regions of a country and the rest grew by 60% over the last couple of decades. And while convergence across countries has been taking place, we also see in many cases divergence within countries, albeit this divergence has stabilized somewhat since the crisis. So we don't have the figures of the past 2-3 years, but you can see so far the development. So some progress may be made in the last 2-3 years. So the pace of reforms has slowed, especially in the countries hit by crisis, as you can see here, and more reforms really are needed. As you saw, the development which we have seen in productivity and investment and growth, more structural reforms are needed, but the slowdown in the pace of structural reform documented through our Going for Growth exercise is deeply concerning. This Going for Growth publication is OECD's flagship annual report on structural policies, and here we have had a look to what extent countries have implemented the reforms we have suggested them and recommended them. And really, as you see here, concerning these countries which are covered on this slide, the pace of reforms has steadily declined in Europe since 2011, 2012, but the pace has also been a bit uneven, so some progress made in certain countries. And that being said, countries where we found that the pace of reforms to have increased in 2015-16 as compared to 2013-14 include Germany, Denmark, France, Italy, and Sweden. And here you see the same development in Central Europe, so same kind of phenomena, the growth or the performance has worsened. But really, as has been said in many of you actually already in the discussion, and also by the keynote speakers today, reforms are needed. But what we recommend the countries to do is to package the reform. So in many countries, the reforms which have been undertaken, they have been undertaken in either labor or product markets, but not so often in both areas. And really, in order to achieve results, this packaging is what we highly recommend. And here you can see that when it comes to our recommendations, for every country, we make recommendations for at least in 2 areas, in jobs, in skills, or in firms. And when it comes to jobs, labor market reforms, more flexibility in the labor market, in skills, better lifelong learning opportunities, improving the education system, and also giving to those people who lose their jobs possibilities to retrain and educate themselves more. And then when it comes to firms, more innovation, more competition, less regulation. And then, ladies and gentlemen, when it comes to these recommendations to the European Union here in a nutshell, so we really much see the future of the European Union the same way as the Commission when it comes to the recommendations. First, what is needed is to increase the public investment, especially in those countries where there is room for maneuver. And also what is needed is the leveraging of private investment. And of course, this is what the Juncker plan also is aiming to achieve, and it should be pursued. Also, a faster implementation of Europe's energy, telecom, and digital single markets is vital to foster investment, productivity, growth, and trade. And I would add here also the services market and the single market in services. More work is needed also in that area. Further, addressing remaining problems in the financial sector, bolder action to resolve non-performing loans, completing the banking union, ensuring that financial resources are channeled to productive ends with special focus on SMEs. And also the EU needs to better support its citizens in the face of globalization. And this is, of course, mostly in the hands of the member states. So more effective upskilling, retraining, guidance, and job search support for youth and the long-term unemployed. Also increase the focus of education policies and lifelong learning would facilitate a swifter transition of workers between jobs and the adoption of new technologies. We have helped many European countries in designing and implementing reforms and policies in these and other key areas. We have worked a lot with Italy and Spain, also with France when it comes to labor market reforms, and also together with the Commission in the Sigma program, we improve the public governance and management of the neighborhood countries and the countries which would like to join the European Union. And also with Greece, we have had quite a deep cooperation when it comes to designing and also implementing the structural reforms. So happy to continue that work with your governments. But to conclude my presentation, a few words on EU's cohesion policy, which I know that is currently discussed not only at the European Parliament, but also in national parliaments when heading towards the next phase. And here, in a nutshell, the OECD's vision how cohesion policy should be developed. So this place-based policies really has a role, and it is complementary to structural reforms and really critical for inclusive growth. So the European structural and investment funds are the main place-based tools in the European toolbox and are important for newer member states, but also Eurozone countries for which there are no intergovernmental budget transfers. So they are increasingly focused on helping regions anticipate change, not merely respond to it. And at a time when subnational public investment has been hit hard, as you saw, these funds have been one of the few stable sources supporting investment during this post-crisis period, particularly for subnational governments. But really the question is how to make most of these funds. Of course, these funds have increasingly focused on the key enablers for economic growth, including infrastructure, innovation, and skills. And they should continue, of course, on this track. And several factors can help make the most of these funds. What is needed are complementary structural reforms, such as those just mentioned. They are one step and a reason for having also the ex-ante conditionalities associated with their use, and a need for the different regions to identify their most important bottlenecks to growth and pressing social challenges to tackle those head-on. And also EU regional policy should add to, rather than substitute for national public spending. So we have also been looking at the EU budget focused on results. So this will be launched after some months. We have contributed to the Commission's efforts in order to reform the budget system, but so far, as you can see here, the EU is performing quite well. There are strengths in the EU model of budgeting for performance, which is very well specified by global standards. But actually, Mr. Chair, I think I have used all my time already, but what I want to, ladies and gentlemen, say at the end really is that cooperative solutions have enabled Europe to cement growth and make it more inclusive, and this continued cooperation is needed to implement effective solutions to common problem. And the alternative to collective action is not status quo, but something worse, and the risk that Europe will move backwards. And the OECD stands ready to work together with you to address these fundamental challenges through contributing our experience and sharing best practices through our cross-cutting forums. Thank you, Mr. Chair. Thank you for your attention.
Thank you, Ms. Kiviniemi, for this interesting presentation. And before moving on with the debate, I will give a word to Mr. Gualtieri. And please.
Thank you very much, Chair. But I think we had two excellent presentations, and so I look forward to listen to the comments of colleagues. I think that indeed they show very clearly that we have not just cyclical but structural problem, and we need both structural reform and investments. I would not see that the thing in contradiction, and I have some doubts on the concept of negative effect on incentive by transfer. Is there a good transfer, of course, and we see that structural fund provided, youth structural fund provide a good quality of transfer. Indeed, we need to improve our capacity to implement structural reform. I think also we need to improve the quality of our concept of structural reform to make it a bit broader, because I make an example. We are saying now two things that we need to reconcile more. We are saying, yes, we need for flexibility in the labor market, and we are saying we have enough rise of wages and we have problem inflation, and even we see the ECB saying, oh, we need a bit more trade unions, be a bit more stronger with wages. So what does it mean? It means, of course, flexibility is good, but just thinking that we regain productivity compensating the lack of the fixed exchange rate with just labor devaluation maybe is not what exactly we need. So then we need flexibility, but also wide social protection networks, and not just to. So this gives an example how our concept, maybe a structural reform, needs to become a bit more granular, more also up to the challenge of a big challenge of a need to increase our output gap, to have more innovation, more research, more school, more children learning, more students going, also not to do just just also doing, let's say, pure sciences. So I think we need also a reassessment of to make it broader, of our concept of structural reform, where I totally agree, maybe incentive do work better than fines. We saw altogether how in concrete, the first example of application macroeconomic conditionality didn't work very well, actually, and everybody was looking just for a solution, not to have to do this. So I'm afraid that we need to find something better. But I also agree, I'd say, with Governor Hanson that we need also the incentives, financial incentive alone doesn't work. We need really the ownership. And that's why we as a parliament propose this concept of a convergence code, trying to combine common targets and national means in a better way, more in line with the concept of multi-level governance. Final remark, and I will be careful. We all should be careful about unintended consequences. I was saying something before. Yes, market discipline is important. Where market discipline provides more disruption that could result, then it might be counterproductive. Yes, bold action of MPS are needed, but you just produce an addendum which forced to sell altogether the NPLs, and you have the decline in the price. You might make happy some hedge fund, but not providing a problem to really improving situation of SME and bank balance sheet. So that's requires of high quality of our policy actions, and that's the challenge, and that's also where I hope our debate will give us more inspiration. Thank you.
Thank you, Mr. Gualtieri. Now we'll move on with the debate, and I'll remind you that to keep your personal interventions in 2 minutes. And the first one will be Ms. Maria Plus from Sweden. So please.
Thank you, Mr. Chairman. I have a personal reflection on the European Fund of Strategic Investment, EFSI. I, of course, understand the need of investments in Europe, and that EU have to encourage growth and well-prepared projects. But I have some questions about EFSI. In the light of Brexit and eventual decreasing EU budget, how do you look on the future of EFSI after 2020? The evaluation of EFSI is to be done as late as 2018, after the increasing of the EFSI budget. Could you please give me some reflection of that? And at last, do EFSI fully compensate for the other missing structural reforms? Thank you, Mr. Chairman.
Thank you. Next intervention from Mr. Jānis Vukans from Latvia.
Thank you, Honorable Chair. I would like to share some thoughts on the topic: what incentives could assure more efficient implementation of structural reforms in member states, based on our Latvian experience. We in the Parliament of Latvia fully share the view that there should be efficient incentives to implement structural reforms. We see that both reward instruments and sanction instruments should be in place. It's clear that real structural reforms bring long-term fruits, but often require fiscal and political short-term costs, and therefore politically it's very difficult to implement them. On the reward side, we in EU already have the SPG flexibility instruments allowing member states to deviate from deficit targets in case of implementation of structural reforms with positive long-term effect on public finances. We think that these mechanisms need to be improved to ensure that flexibility clause is granted only in the case if there is verifiable positive fiscal effect. If member state fails to implement reform, deviation should be annulled and full compensation of deviation should be required. We have also arguments to support stronger linkage between the EU funds programming and envisaged structural reforms. What concerns the sanction side, we are skeptical of ideas to suspend EU structural funds in case countries fail to implement reforms. Why? Because if structural reform is not implemented, it's natural that these funds either are not used or are redirected to other projects. But suspension of EU funds as sanction mechanism, in our view, is not fair. Both net recipients and net contributors need to implement structural reforms. Taking into account spillover effect from successful reform implementation, both net recipients and net contributors gain from reform implementation. Therefore, the sanction mechanisms should be developed in a way to ensure equal treatment among net recipients and net contributors. We see two main ways to explore: the introduction of fines and market discipline, like automatic sovereign debt restructuring if country fails in structural reforms, apply for the European Stability Mechanism program. Thank you.
Thank you. Next speaker is Lord Desai from UK again.
Thank you, Mr. Chairman. The decline in productivity growth is not just an EU problem, but it is basically a global problem, as Robert Gordon's book on the USA shows. Productivity is declining everywhere. And some of the fundamental questions we need to ask are really about, are we measuring the correct thing? And is it possible that productivity can go on growing if the economy is shifting from goods to services? Because productivity is more difficult to measure in services than in goods. Notice that 4 of the biggest corporations today are all in service sector, and and they're not in manufacturing. You have Facebook and Google and Amazon, people like that who just basically make lots of money. And how do you measure productivity of Facebook? So I think we have to be careful about what we are measuring and are we measuring the correct thing. Secondly, I would like to say that we need to take the view that perhaps we are at the end of a long cycle and we are waiting for the upsurge of the next set of innovations. And we don't know where they're going to come from, but they're not going to come from government policy. They're going to come from private initiatives. And the question is, how do we make it possible for private initiative to have growth? I think the only condition would be to have a accommodative monetary policy which will give low interest rates for inventors, which therefore they can take risks.
Thank you. Mr. Kai Turunen from Finland.
Thank you, Chairman. Let me say a few words on national reforms and measures taken in Finland to boost growth and investment. I'm happy to say that we have been able to bring Finnish economy back in the path of growth. We have taken and are still taking reforms and investments. I would highlight areas like bioeconomy, clean technologies, and digitalization. I would also pay attention to investments like a bioproduct mill with value of 1.2 billion euros on this year. To boost investment, we also need a good regulatory framework. We need to make sure that EU regulations do not create obstacles for investments in Finland. Thank you.
Thank you. Mr. Dimitrios Mardas from Greece, please.
Mr. Chairman, in this session we have some key words, let's say. One is recovery, the second is how to boost growth, and out of financial tools, we believe that we can boost growth through structural reforms, through pressure for more labor market regulations and all that. And why all this? Because we want to increase productivity and hence competitiveness. And all this because we operate in an open international market. where we face international competition. Mari has pointed out two interesting things. The first is that we saw through the tables that there is a decline in productivity and investment in the frame of the industrial countries. And the second, that there is a persistence in huge growth of India and China. And one question that we have to face in the context of Commission first and then in the frame of the other institutions of the EU is the following. If we face some threats which are associated to this international environment, we have to give the appropriate replies. What is a main threat? A main threat is dumping on behalf of the third world, of developing countries, and it is very interesting to see the social dumping which is applied. And everybody operates in the context of the open economy. In this case, if we consider that there is such kind of threats, we have to insert appropriate measures. I have heard that Commission decided to insert as selection criteria the absence of selection criteria in the context of public procurement, the absence of underage workers of countries which are suppliers of the EU market. This is correct. And I think that we have to extend such kind of regulations in other areas. Second point, regarding investment programs, I think that we have to increase cross-border cooperation under any kind of scenarios, for example, to reinforce more subcontracting between industries. And finally, we have to push funding in the area of education and health, and all these efforts has to reinforce the social economy in the frame of the European Union.
Thank you. Mr. Peter Böhringer from Germany.
Thank you, Mr. Chairman. I would like to make a comment, and I have a concrete question directed at Governor Hansson. First, I would like to remind you that the European Union is an alliance of sovereign nations and doesn't have the quality of an independent state itself. And I'd like to remind you of the principle of subsidiarity. Things should be regulated wherever they can be regulated at the lowest level. So it should be the usual case that investment programs, the rescue programs, economic programs, are established at national parliament level and not at the level of the European Union, and also not by the ECB, which is the current normalcy. And today and tomorrow, this is what we should not forget, just as a side remark. And deriving from that, a question directed at Governor Hansson, now that you're here. The biggest ECB program at the moment is the Asset Purchase Program, CSPP, and of up to 60 to 70 billion euros per month. So the ECB is more or less a monopolist here, and it has it's the only buyer of these bonds, and directly or at least indirectly. So these bond purchases that make up a large share of the rescue packages at the moment, do you personally believe that that is monetary policy or is it fiscal policy? Thank you.
Thank you. Miss Carla Parush from Portugal.
Mes salutations, mesdames et messieurs. Je prends la parole pour partager.
Thank you very much. And I would like to take the floor in order to express my opinion, what can be done in order to find a better approach and coherence when it comes to financial measures in the EU. To the greatest extent, I have to say that we have to really continue with the resources we have available to us. If you look at the principle of subsidiarity, the employment, the social inclusion, all the competencies, the research and innovation, all these aspects are still very important. Now, the economic and social differences can cause conflicts in the field of social politics, and therefore we are obliged to find answers on the EU level. So now, to conclude my brief statement, I have to say that we need to continue and to correct these scenarios in order to solve these problems together. Thank you.
Thank you. Mr. Christian Petri from Germany.
Thank you very much. I believe it is very good that we have a strong European component in fiscal policies. We know there are areas of policy areas that cannot be dealt with at national level, whether it's climate policy, peace policies, or also the question of global digitalization. In this context, I'd like to point out that subsidiarity is important, but fiscal policy and European programs have to be assessed in a positive way, also from a German point of view. My question refers to the assessment of the reforms carried out by the European Union. You mentioned the European semester and the active monetary policy of the ECB, which led to price stability. There are individual measures required at national level when it comes to implementing reforms. That is self-evident. Something that works in Germany doesn't have to work elsewhere, and vice versa. So I'm happy that the investment programs of the European Union take this into account. But the question is, if I use Germany as an example, when you implement structural reforms and when you're successful with this, there is the risk, as we have seen in Germany, that you see an increase of people in precarious employment, and these people need to be the focus of attention after the structural reform. So my question for the panelists is, are social aspects included in the OECD measures or in the European semester? Because I think for the further development of social policies in Europe, it's extremely important to do this. Thank you.
Thank you. Mr. Christos Staikouras from Greece, please.
Thank you, Chairman. What are the main lessons that can be drawn from the implementation of financial assistance programs in several EU countries? To overcome the crisis, it is essential fiscal discipline to be combined with delivering growth-enhancing structural reforms. Accurate fiscal multipliers and the appropriate composition of consolidation are crucial for sustainable public finances. Fiscal rules with embedded expenditure ceilings tend to generate durable results. A financial envelope that ensures the stability of the banking system is necessary. Programs should guarantee social cohesion and cater for the most vulnerable. Sustained ownership of the reform agenda is crucial for program success. Greece, over the last 7 years, with substantial costs for the society, implements a bold economic adjustment program through the painful process of internal devaluation, which has led to the elimination of the twin deficit problems. However, many more should be done by the government and institutions to capture the widening growth gap. We must set priorities, acceleration of structural reforms like those included in the OECD toolkit, and intensive implementation of the privatization program. Provision of liquidity to the real economy through absorption of EU funds, enhancement of public investment, repayment of arrears, and bolder actions to resolve non-performing loans. Change of fiscal policy mix, moving towards a gradual reduction of taxation. abolishment of capital controls and participation in the QE program. And finally, adoption of a national strategic plan for the productive reconstruction of the economy, investing in endogenous growth sources like education and innovation. Thank you.
Thank you. Mr. Paolo Corrieri Paleotti from Italy, please.
Thank you, Chairman, and thank you for the excellent presentation. I'd like to add one further dimension about structural reform. And it's a kind of dimension that economic analysis and IMF have been suggesting several times, and even more recently. And it is the one that should distinguish between the structural reform that boosts aggregate demand more reliably and generate growth with respect to those reforms that destroy it. In this perspective, what should encourage during stagnation phases or weak recovery those structural reforms that support short-term growth, while postponing or discouraging those reforms that weaken demand and could penalize economic growth. In other words, structural reforms are not all the same, and one should distinguish between them. As IMF shows, product market liberalization, for example, which increases both people purchasing power and companies' productivity, can be expected to boost growth, whatever the economic environment. But if we take labor market reform, for example, the things are different, and one should be very cautious in how to distinguish among them. For example, they don't work well at times of fiscal tightening. Those kind of labor market reform that reduce demand could be even harmful in a recession. From this point of view, I think that it's very important to highlight that in today's circumstances, the most promising labor market reform are those that stimulate demand, such lower taxes on labor and a bigger budget for labor market policy to get more people to work. So I'd like to ask both panelists what they think about this dimension and this distinction that is quite promising in terms of impact upon economic policy. Thanks very much.
Thank you. And now Mr. Jens Brandenburg from Germany.
Thank you very much. We have talked a lot today about how the European family can be supportive and provide solidarity if some countries are in trouble. And the question is, how can we get these countries out of trouble, and how can we prevent this problem from developing in the first place? As a representative of the young generation, I'd like to express my disappointment that the reform efforts, i.e. the efforts to improve things at a structural level in the long run have dwindled out in the past years. We know it's very hard that reforms aim at long-term effects and have a very high short-term cost. And as a policymaker, you only want to win the next election. But we have to clearly understand that this is not that reform measures are not only happening on the backs of the policymakers, but that the young people in one's own country might have to suffer from these consequences in 10 to 15 years in difficult economic situations, bad job prospects, bad public investments, and inefficient state structures. Those are the young people who will have to suffer in the long run. If, for example, financial incentives by linking the European semester with European subsidies can help to revigorize these reform efforts, then this can be positive as long as it is not used as an excuse to increase the overall budget. But I think the most important thing for everybody represented in national parliaments is that it is our own responsibility in our own countries to carry out the reform efforts despite all of the political incentives.
Thank you. Ms. Margarida Marques from Portugal, please.
Thank you, President. I'd like to raise two different points, more on institutional areas. The first one on better supervision. It means I have the experience, we have the experience, different countries. Here we are speaking, the document speaks about 8 countries that had the support of the European Union. I know better the position of Portugal, and I'd like to raise this point, better supervision, because I think that we need to find a more democratic supervision model. And we need to reinforce the role of the European Parliament and national parliaments. And when we speak about policy advice, we need to respect more the democratic models and the national democratic institutions. A colleague from Germany spoke about diversity, and I'd like to underline and to repeat this approach. Diversity is a key word. Second point, to move from the ESM to EMF. We defend this movement, but we need to underline the fact that this movement from ESM to EMF needs to be integrated, trying to find a new global framework for economic governance. And we need to avoid the reinforcement of the intergovernmental approach. It means this movement needs to be done in the framework of the communitary model. Finally, I'd like to thank Mary Kiviniemi for the OECD, to remember here the OECD recommendations. And I'd like also to underline one recommendation on the recovery financial sector, the recommendation on completing banking union, but also your recommendation on better support citizens to face globalization are also very interesting. Thank you very much.
Thank you. And now, Mr. Eric Werth from France, please.
Merci, Monsieur le Président. Il y a beaucoup de débats à la Commission des finances et plus largement à l'Assemblée nationale française sur le...
In Financial Committee and in the Parliament of France, the structural aspects of reforms are discussed, how to calculate the structural deficit, etc. And this brings about different questions. But when we look beyond instruments, I believe that there is broad-based agreement on which reforms are necessary in order to promote economic growth and consolidate it. And as the OECD representative said, this is very important. But we also need to think about whether the lack of investments in Europe, whether the lack of investments is caused by the fact that our processes are slow and that the investment plan does not go hand in hand with economic cycles. Maybe the lagging behind is the main aspect. Thank you.
Thank you. And now Mr. Paulo Trigo Pereira from Portugal, please.
Thank you, Mr. Chairman. I would like just to make a comment and 2 questions for the speakers, which I thought was very interesting, their comments. My first comment concerns the countries that had adjustment programs. And let me just say that passing from an extraordinary fiscal policy situation where you have to cut salaries, freeze pensions, freeze admissions in the public sector, freeze progression and promotions in the public sector. So this is what most of our countries who have under adjustment programs had. To, let's say, normal fiscal policy, it's not easy. And it's understandable the data that you have presented, at least for countries like Portugal and perhaps Ireland and others, that even though we are having a good record, but of course we are changing a little bit the policies, because we could not sustain exactly the same policy that we had in the adjustment programs. The question, the first to Mr. Hardo Hansson, he said something very important, that there is a time lapse between the decision to use structural funds and their real impact, which sometimes take 2 years, and instead of being anti-cyclical, they become pro-cyclical. And my question is, have you got any idea how we could speed this up, because this is a problem for Estonia, it's a problem for Portugal as well, and I believe other countries. And for Ms. Mari Kiviniemi, one important thing, very important, that you said is that we need to identify the bottlenecks to growth in regions. And my question is whether, first, this could not be done if countries adopted program budgeting with well-developed good indicators of performance to know exactly where are the problems. And secondly, if we could not know more exactly the regional impact of structural funds. For instance, and I finish with this example, in Portugal, we realize now, after 500,000 hectares of forests were burned and 100 people were killed by the fires, we realized that the money didn't go exactly to the places where they should be. So perhaps more transparency on structural funds on regional basis would help. Thank you very much for your attention.
Thank you. And the last intervention comes from Mr. Marios Mavridis, Cyprus, please.
Thank you, Mr. President. Last but not least, let me find my intervention. The biggest problem with the successful completion of economic and monetary integration is that we cannot start from the beginning. Instead, we have to do it through structural reforms. Sometimes it is better to demolish an old house and build a new one instead of trying to fix the old one. It is well understood, however, that economies and societies are not houses. It is therefore inevitable to go through structural reforms in many countries in Europe and in the European Union overall. Recent experience in Europe has shown that reforms are easier in some countries than in others. In some countries, various interests like unions in the public sector, professional associations and other groups exert significant power on governments not to proceed with reforms. As a result, reforms are delayed and the cost of reforms is rising even more. If we can measure the value of foregone reforms due to the delaying of reforms, I'm sure we will all be astonished. The experience of Cyprus is worth noting. A lot of reforms took place during the economic and fiscal adjustment program under pressure from Troika, but a lot of reforms have not been done. Now that the adjustment program is over and the economy is growing, reforms are slowing down. Unfortunately, in Cyprus, we have the presidential system of governance and the opposition is stronger in the parliament. Maybe we have to wait until Troika comes back again. Just kidding. I believe that the European Union must find a way to push for structural reforms and other reforms in member states before a member state goes under. When a member state goes under and asks for help from the European mechanism, it may be too late. It may be forced to proceed with the reforms, but the cost to the society will be very large. Thank you.
Thank you for this comment. Now we have approximately 15 minutes till the end of the session. We have questions, concrete questions to Mr. Hansson and Mr. Kiviniemi, and then Mr. Gualtieri also can make some comments or remarks at the end. So I will start with Mr. Hansson, please.
Okay, thank you, Chairman, and thank you for all the comments and the questions. I think a few were directed to me, and I might comment on one other one as well. But the first was from our Portuguese colleague about this, how to improve the public investment implementation of all these EU projects and so on. And I'm not a public investment management specialist, but I think one channel, a year ago in our country, when we looked at it and we saw this was very slow, the money wasn't moving very fast, and we said this seems to be a problem. Some people would counter and say, speed is not the only thing, quality matters as well. And I think we can err also in the opposite direction of just moving the money on all kinds of projects that are poorly conceived. In the end, you have recurrent costs that you have to finance, and in the end, you maybe regret some of these quickly planned projects. So one is clearly striking striking a balance. Maybe one issue is that there are three different parts of the general government. One is the central government using our own resources. The second is then local governments who are doing their own projects from their own budgets. And the third is then these EU funds, which somehow are on a different track. And maybe, at least in a kind of a macroeconomic planning perspective, to put these all together and to maybe have an opportunity when EU funds are not moving so fast, then to compensate in those periods with more domestic investment. And then when they start moving the EU funds, then it's possible to scale back the domestically funded and make those investments somewhat more fungible. That's just one possible idea. There was a question from Mr. Boehringer about the ECB policy, and I think, first of all, I think subsidiarity is an important principle, and I think much of what I was saying earlier was derived from that. As regards the monetary policy, asset purchases and so on, whether they're monetary policy or fiscal policy, this is very tricky, and I think we have a framework in Europe, some of the treaties and so on, which try to impose limits to assure that that these two policies are to a large degree separated. These are prohibitions on monetary financing, and then the ways in which central banks introduce certain operational targets are meant to guarantee that those principles are adhered to. And I certainly believe in the fact that we should maintain certain limits on policy. We have, for instance, a limit right now that the central bank only buys on the secondary market and can only buy a maximum of 33% of any one issue. That's meant to ensure that the market is still functioning, that private investors are accounting for at least 2/3 of the market, and it's to ensure that the central bank doesn't completely dominate particular markets. I think it's very important that we, even sometimes when we feel that these are frustrating limits, we should abide by them. The other issue is that when we were designing these policies, then if you looked at more federal jurisdictions such as the United States, where you have your own government bonds, then it was not, these issues didn't arise of whether the mixing up of monetary and fiscal policy. But in the European case, where politically we have not taken this decision yet to go to a much larger degree of mutualization, for central bankers to introduce that through the back door would be problematic. And I think that's why it explains one of the features of the program is that 4/5 of the asset purchases are bought on the accounts of the individual central banks. They earn the money from those assets, and when there are losses, they absorb those losses. And I think it's a particular way of trying to do asset purchases, but respect the European specificity, where we have not yet taken these political decisions. Finally, I think there was an issue of will some of these EFSI reforms compensate for, let's say, lack of structural reforms, and I think that would be bad if it were happening. I think there was a period when we maybe overemphasized investment somehow. Current consumption very bad, investment somehow very good, and I think there was even a period when the IMF was saying, if you're really good at planning public investment, these investments can almost create their own fiscal space, and therefore there's almost kind of a free lunch element. And I'm sure that in principle that's possible, because there must be bottlenecks. If we were really ideal public investment managers, we could somehow identify real bottleneck projects and they could pay for themselves. But in reality, I think sometimes the ability of our systems to deliver a range of public investments, all of which are high impact, can be set in question. And in these circumstances, I think it's not so simple to just say the more investment we have, the better. Thank you.
Thank you for these comments. And now, Ms. Kiviniemi, please.
Thank you, Mr. Chair. Thank you very much for the comments and also for the questions. I try to answer the ones which were made to be answered by me, and also comment some other issues you took up. So when it comes to these European structural investment funds and cohesion policy, I already in my presentation gave kind of some concrete advice how to proceed to the kind of fourth generation of the cohesion policy, but I have to say that many advances have already been made earlier. More transparency at the regional and national level, yes, of course, ex ante, ex post evaluation, and as many of you pointed out, this funding should go hand in hand with structural reforms. But also one of our advices is to connect urban and rural areas to support greater diffusion of innovation and growth from cities. Also, you should improve the capacity of all levels of government when it comes to using the funds, not only the FC funds, but also the national ones, when it comes to investment. And also, you should link the cohesion policy and also in general regional policies as closely as possible with other sectoral policies. Then the question of productivity, yes, it really is true that it is a global phenomenon, and that's why also at the OECD we try to find answers to that. We have established a global forum on productivity, which meets once a year, and where we tried to find a solution also to the question of measurement. Do we measure it in a right way? But also to the question how to improve and increase the productivity, not only national, but also at the regional level. Regulation was mentioned by many of you, and yes, the OECD advice really is to the European Union that less regulation and more harmonized regulation, so that also the SMEs have it easier, for example, in the services market, to offer their services in other EU countries, which is not yet the case. So less and harmonize is kind of our advice and the creation of a single market. And the fourth point I want to take up is the question concerning OECD's work, that how do we consider kind of the social aspects in our recommendations. And I have to say that they are, of course, built in to our recommendations. What we encourage countries to achieve is not only better growth, but also inclusive growth. We see that too much inequality, it harms growth in the long run. And of course, it also, as we have seen in many countries, also creates political instability. So our advice is really to improve the opportunities for every person in all parts of the countries, better education policies, skills policies, and also health and social policies are needed, but also in order to tackle the challenges of the globalization, better international cooperation, so that all the countries play with the same roles.
Thank you for these comments. And Mr. Gualtieri, please.
I would just a quick answer to the question on EFSI Juncker plan after Brexit, which is a difficult question, but at least we a few days ago concluded successfully the trilogue on EFSI 2. So now we have a prolongation of EFSI, a budget, a new budget for it. So we have we are transforming this as a more permanent instrument. Of course, Brexit will create an issue for the whole balance of the EU budget, but we are, confident that we will conclude positively the negotiation in order that all the commitments and the liabilities will be honored, as said, in a fair way. So then it will be more for us to update and improve our mechanism of own resources in order to continue providing financing to this instrument, which has been proving to be very successful, which I think is complementary to the existing structural funds. And one of the new tools we are exploring and trying to develop is exactly the blending between the structural fund and EFSI financing in order by enhancing, let's say, the grant component of the necessary project to make it more able to address market failure at suboptimal investment conditions. So this is a new avenue that I think we should explore, which might work successfully as it is already working successfully. Final remark, just to very much stress, and I'm very glad that also OECD agrees on that, that we need to improve let's say, the social dimension of our concept of structural reform. This is absolutely essential. We're going to approve on Gothenburg, I understand, a new important document on the social pillar, but in order not to make it just a declaration, we need to transform it in concrete policy action in order to fully streamline this dimension in our policies, which is, I understand, essential to address the challenges, among which I very much support the Mr. Desai comment. It's worth reflecting on how currently we are having productivity gains in the service, but not in goods, and that's bring us back to the challenges of globalization and growth potential, and the need to put together all the efforts in order to increase our productivity and growth capacity. Thank you.
Thank you, dear panelists and dear participants. The session is now over, and some technical information. The buses are waiting for you, and we have dinner starting at 8 o'clock in Estonian Concert Hall, and the buses will take you on 7:30 from your hotel, so hopefully you will all come there, and we will start tomorrow at 9 o'clock. At 8:50 the buses will take you here, so let's have a nice dinner and then continue this discussion that we had in 2 sessions today, hopefully in a dinner table as well. And panelists, once again, thank you, and I think we can make some small applause. Thank you.